we're always changing and evolving as it relates to the economic cycle. I wish we could just stay in one place, but that's not how it works. If the unemployment rate is changing and shifting like a pendulum to a higher unemployment rate, if inflation is shifting like a pendulum to lower inflation, to us, that means lower rates. And I think one of the things we're anchoring on as investors is still thinking about the COVID era monetary policy, fiscal policy, disruptions to the global economy as the new normal. And it's not. That was a massive outlier that likely will never happen again, knock on wood, in our lifetime. And therefore, if we're back to the way we were pre-COVID, why wouldn't we be back to a lower rate regime? And if it's a lower rate regime, that's actually good for stocks and bonds. It means lower inflation, but it likely means bonds has more catch up after equities have done so well as of late.
So it sounds like you're still overweight bonds relative to stocks at this juncture. What could make you flip that, given the fact that ultimately this is a pretty benign setup for stocks, given the fact that we spent years talking about how low rates really boosted valuations among equities?
So strategically, stocks have done always better than bonds longer term. And so we are just a modest underweight to stocks versus bonds. But the biggest change we made in our tactical views is just overweighting higher quality parts of the market. So on the equity side, we're overweight higher quality markets, technology, U.S. equities, U.S. larger cap versus smaller cap. And then in the bond market, investment grade corporates with about a single A credit quality is about as much credit risk as we really want to overweight. Agency MBS, investment grade corporates are things we like. We were doing 5 to 6% in yield just a couple of months ago. Now we're doing 4 to 5. But again, on a risk-adjusted basis, we think that's really competitive versus stocks here.
Matt, you're not scared of being contrarian. Do you find it uncomfortable that what you're saying this morning is basically what everyone's been telling us now for the last month?
So I hear that a lot, right? So, well, I don't hear that a lot, but nowadays we are hearing that everyone's bullish on bonds, right? And utilities, as you said earlier in the show, John, around the fund manager survey, the interest rate sensitive sectors. You know, and I look at the pricing, though, of the market. And I also look at the guts of the market and just cross-asset performance. So we've got gold doing great, the yen doing great, treasuries doing great. Those are all defensive. Those are all saying, hey, the economy's slowing, inflation's slowing. Then you got high yield spreads at super tight levels. The S&P multiple is really high, and it's more small caps are starting to do well. We're getting cyclicals out of Europe doing well. So it doesn't add up. That's the part of the consensus that I don't get. If you want to say that everyone is more bearish or suggesting more rate cuts, there's this other part of the market that is saying that's contrary to that. So I think you just need to be careful with that. When we look at what's priced in, it's a lot of good news on the risk front. And to me, that just needs to be shaken out here because the Fed can't do everything. They can't just cut, consistently and meet up to these expectations and then, support everything that has happened here. So we just want to take a more managed, risk-managed approach, a more conservative approach. We're not underweight, we're not underinvested, but that income is a key component, and that's to us going to pay off over time.
Matt, just love your thoughts on how we're priced going into tomorrow and how you think we might respond to any given decision. Do you think it's sufficient just to validate market pricing of the dot plot? Is that enough, or does this market need more?
I think that's key, John, to your point, because they could just say 25 or 50, but then it's how do they say on top of that what we're going to do is the end of the year? So in the June summary of economic projections dot plot, they said 5.1 on the Fed funds rate by the end of the year. That was the median. That has to come down to some degree, or else the market's going to be pissed. Right? Not to overdo it, but it's not going to be happy unless they say on top of this cut, hey, we're still suggesting cuts to come because, again, if they're not easing, they're tightening. And that's okay. If they want to push back on the bond market, if they want to push back on the easing that's already baked in, that's fine. But they got to know that that's what they're doing. And it's a precarious time to really put more tightening into this market. We would follow the bond market. If you want to create a soft landing, you need that. You need tight credit spreads, and you need initial jobs claims to stay low. If you get those three things, you can keep a soft landing. If not, you're probably looking at more risks to come.
Matt, just to sort of underscore one point that you just made about the stock market just generally being pretty ticked off, there is a question about whether this Federal Reserve cares. It didn't really care on the way up. It seems to care on the way down. Is that basically the litmus test that we're working with?
Well, there is a wealth effect to these things. So, consumer net worth through the second quarter hit all-time high, ridiculous trillion dollar amount. But that's probably helping the economy. That's probably helping consumer spending. That's helping consumer confidence. And, the markets are very fickle and volatile, and it's very difficult for the Fed to over-extrapolate things because it could change on a dime. But at the end of the day, they do need to be cautious of being too dovish because, if the wealth effect becomes even bigger, if housing continues to go higher, that's going to lift inflation. And if stock markets continue to go up, we could be, cautious here because of more bubble territories. We've had lessons of not overstimulating with ultra low interest rates because it can create bubbles. For us right now, cycle-wise, we want to protect on the downside. I think their dual mandate, they got to focus more on employment than inflation. And that's really what we got to look at. But they've got to use the side of their eye. They've always got to be watching for too much speculative nature in markets. And we're coming off some pretty significant speculation, but it's still not relieved from the market yet.
Matt, just a reminder for next time, we curse in surveillance after hours. That's a podcast coming in Q4. Where there'll be lots of cursing, drinking, smoke if you want, cigarettes, cigars, whatever you want.
Yeah, that's you.
Just breaking all the rules.
Oh, yeah, completely. Let's not get carried away. We'll just curse.
Matt Miskin and John Hancock, plenty of cursing. Coming to a podcast near you. That would work, wouldn't it? Surveillance after hours. Don't you think?
Attract the junior high school crowd.
Attract all sorts. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Intel shares are rising nearly 7% in the pre-market after the chip maker announced a new partnership with Amazon's AWS. Intel and AWS will co-invest in a custom semiconductor for AI computing known as a fabric chip in a, quote, multi-year, multi-billion-dollar collaboration. The news was part of a flurry of announcements that followed a pivotal board meeting last week. Intel also saying it's postponing new factories in Germany and Poland, but remains committed to its U.S. expansion. Meanwhile, Tupperware Brands is preparing to file for bankruptcy as soon as this week, according to people with knowledge of the plans. The home goods brand, which has defined food storage for much of a century, is planning to enter court protection after it breached the terms of its debt and enlisted legal and financial advisors, according to those familiar. And Starbucks is creating a new leadership role focused on the company brand as its new CEO Brian Niccol tries to boost sales and bring back its cozy coffee house vibe. In Niccol's first major move since taking over last week, the company will create the new role, which will oversee things like product, marketing, and store concepts. The news comes as the company's North American CEO Michael Conway announced he will retire in November and his role will not be filled. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in 30 minutes' time. Up next on the program, Wall Street looking for a divided government.
I think the best case for most investors is a divided government scenario where having a Democratic president, potentially divided Congress, means that we have status quo, not a lot of new policy.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York, welcome to the program. Equity futures positive by 0.25% at 8:30 Eastern Time. An important data point that we're told is even more important than it typically is. It's US retail sales. This from Andrew Holdenhorst of Citi. We were talking about this just moments ago. A softer than expected reading could further increase pricing of a 50 basis point rate cut, which would in turn make Fed officials reluctant not to deliver what the market expects, echoing the argument that B. Mosey and Lincoln made on this program 30 minutes ago.
We're narrative hunting. That has basically been the exercise of this market for the past, 2 years. And now the narrative hunt goes to any sign of weakness that will disproportionately be weighted both in bonds and stocks. The key to me will be in stocks. How much do you see a rate market that doesn't shift nearly as much as risk assets that might not be as attenuated to some sort of downside risk?
Stock market close to all-time highs and the bond market yields close to the lows of the year, just off them, up a single basis point on a 2-year, 3.56. Under surveillance this morning, Wall Street looking for a divided government.
The best case for most investors is a divided government scenario where having a Democratic president, potentially divided Congress, means that we have status quo. In a Trump scenario, a lot of folks generally assume that's going to be more pro-market, but in our view, there actually could be a lot of macro headwinds should we see new tariffs and potential trade war. A lot of that policy you don't need a unified government to get, so that's irrespective of what happens with Congress.
So here's the latest. Just under 2 months until Election Day, investors preparing for a split Congress with Democrats in serious danger of losing their slim Senate majority. The Cook Political Report expecting increased chances of a GOP-led chamber regardless of who wins the top ticket. Jessica Taylor with the Cook Political Report joins us now for more. Jessica, welcome to the program. Let's lead with your conclusion, your base case ultimately. The Republicans can flip the Senate. What is it about the map that underpins that view? Why is this so difficult for Democrats to hold on?
Well, just the third of the Senate that's up this year is just increasingly difficult for Democrats. They're defending 23 seats to just 11 for Republicans, and overwhelmingly a lot of those are in very red territory. So we start with a 51-49 majority, but because Joe Manchin of West Virginia is retiring, that seat is virtually guaranteed to flip to Republicans, so we're at 50-50. And then you still have the Montana seat in a state that Trump won by 16 points, and Ohio in a state that Trump won twice by 8 points that are increasingly difficult. Last week, we shifted our rating in the Montana Senate race to say that John Tester, a Democrat who's held that seat since 2006, is now the underdog. We now rate that race as lean Republican, that his Republican challenger, Tim Sheehy, is a slight favorite now. So if they lose that race, then they have lost the Senate majority, essentially.
Jessica, many will say, though, don't bet against Tester. Senator Tester's had this seat, as you said, since 2006. He's faced some tough competition in the past. What about this race you think changes that?
He has, and he's won in 2012 and 2018, but those were against some weaker challengers. And in 2012, Romney won that state by 12 points, and he managed to outrun Obama by 7 points. But I think that it's a very good chance that Trump is going to win that state by at least the same margin he did in 2020. In 2016, we saw every single Senate race go the same way as the presidential race in that state. In 2020, only Susan Collins managed to win re-election, even as Biden won her state. She outran She outran Trump by 7 points in that state. Tester's looking at needing to outrun the top of the ticket by double digits. And I think some of the attacks, I think it just comes down to pure partisanship, and that we are we just see an increased partisanship since 2012. In 2018, that was a very favorable midterm year for Democrats. Look, if this were a midterm year, I think it could be a different scenario for Tester, but just with Harris atop the ticket, he has pointedly not endorsed Harris. But I think that just with the D beside of his name, his favorability is now underwater, really for the first time in his career. He started out with very high favorables this cycle, with at least in the high 50s. And I think that the relentless Republican attacks have taken him down. Now his opponent, Tim Sheehy, has questions about his business background, but he's managed to run positive ads also about his military service. And listen, I don't count Jon Tester completely out, but I do think that at this point we have to view him as the underdog.
Okay, so if he's the underdog and he does lose, Democrats would need to, how could they potentially combat this? Is there any hope in, say, a Texas or a Florida for the Democrats?
Yeah, they do have to look to make one of those other states more of an offensive opportunity. And in talking with strategists, I do think that Texas is slightly more doable than Florida. Listen, I think you have to pick one of them. They're both incredibly expensive states. In Texas, you have probably a very good recruit for Democrats in Congressman Colin Allred. You have Ted Cruz there, who has weak favorable ratings. He faced a very tough re-election in 2018 against Beto O'Rourke. But in Florida, you do have an abortion amendment on the ballot that could help Democrats. Rick Scott there, former governor, who's won very close elections in the past, running against former Congresswoman Debbie Musgrave-Powell. She has not had very impressive fundraising. And Rick Scott, a billionaire who can write himself a check. So I think when Democrats are perhaps looking at which state to go all in on, Texas might be a better investment. Allred has had very impressive fundraising there. So I think you kind of have to pick one or the other.
Jessica, and just looking out, the fact that we've had a flip at the top of the ticket for the Democrats, how much has that helped them in some of these states where potentially they would need if they want to maintain the hold of the Senate?
I think it's absolutely helped them that Harris is now atop the ticket. I was hearing a lot of concerns, after that disastrous debate with President Biden, that, Democrats were still outrunning where Biden was, but the fear, a very validated fear, was that sort of the bottom was going to drop out. And so now you do have Democrats that are leading in other swing states, presidential swing states like Wisconsin, Arizona, Nevada, and Pennsylvania. We rate all of those as lean Democrat. But, I think that certainly the switch at the top of the ticket helped them in that regard for sure.
Jessica, appreciate your input this morning. Thanks for the insight. Jessica Taylor of the Cook Political Report. We've talked about this a few times on this program. The advantage that Kamala Harris has, given that she didn't go through a tough primary, hasn't been cornered by progressives, pinned down on very unpopular issues for this country. And I think that's an advantage further down the ticket as well for Democrats that are in very tight races.
Definitely, it's an advantage. But when it comes to the Senate, they have so many seats to defend. To Jessica's point, it looks like it's all coming down to Montana. And Senator Tester may lose this seat. That could potentially mean, even if you have Harris in the White House, Republicans in the Senate, that's why some people on Wall Street think it's going to be gridlock in Washington.
This is why that consensus exists. Will we get a change? Will we get something different outside of consensus when we come to that first week in November?
I don't know. Maybe we will. I keep thinking about this idea of not being tested and whether that brings people out. And there was an article in Bloomberg Business Week talking about how a lot of Democrats don't know who they're going to get with Kamala Harris, the one who was running, say, a bunch of years ago versus now. I just wonder, does it bring more people out to vote? And that's really my ultimate question.
We're looking for a big divide potentially between how you campaign and how you govern. And we could have to see some surprises on that front too. Seen some surprises in the UK, but save that story for another day. Up next, Alaska Lou of Bank of America on the Global Fund Manager Survey. That's next. This is Bloomberg.
decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Stocks are positive once again. We're up by 0.2% on the S&P 500. Call it a quarter on the Nasdaq 100. Pulled back yesterday by what was happening with Apple, and we'll talk about Apple a little bit later in the program. 45 minutes away with catching up with Pierre Farragut of New State Research. So look out for that conversation in just a moment. On the Russell, the small caps up by 0.25%. This is quite a winning streak so far on the headline benchmark S&P 500 index. It's 6 days and about to become day 7.
You pointed this out earlier, all-time highs on the equal weight, and it really is notable to me how much this has been driven by that ongoing rotation trade, the aspects of the market that are most benefited by the incoming rate cuts really has been the Russell 2000, up almost 3% in just 2 trading sessions.
Amazing. The 2-year yield up a single basis point. Not much price action this morning, but plenty over the last few months. Bonds have been rallying. Yields have been falling. 2-year and 10-year yields are at or close to the lows of 2024, going into this Federal Reserve decision, looking for potentially a 50 basis point reduction that we're told by a couple of people, including BMO and Citi. You have to be hinging on this one data point we get in 60 minutes' time.
And how much is that going to color not only what the Fed decides to do, but also how the market responds to it? We've been talking extensively about whether this is ultimately a buy the rumor, sell the news type of event, given the fact that this market is priced in 100 basis points of rate cuts this year, 250 basis points of rate cuts through the end of next year, and a positive tilt, a positive read-through to risk assets to boot.
So you're on the money, as always. This is the conversation we've got to have. Rate cuts with what economic backdrop? Not all rate cuts are created equally. And this is what intrigues me about how the bond market is priced now. It feels like this bond market is priced for a return to neutral over the next 18 months, let's say. Potentially 200 basis points of interest rate reductions. Any more easing price beyond here, you start to talk about a conversation going beyond neutral to accommodative. You can make the argument that we're going back to neutral, it's a soft landing and growth is holding up. Can you make the same argument that we're going back beyond neutral, somewhere accommodative, and growth still holds up? That's where things get interesting from here. Can you price additional easing with this equity market carrying on rallying at the same time? I think it gets harder and harder.
Which is the reason why people can't even agree what this current bond market is pricing in right now. Some people saying that it's already pricing in recession. We got a note from Torsten Slok to that effect this morning from Apollo. The issue is we don't know what neutral is, and we heard Matt Miskin talking about how it's some kind of hocus-pocus number that's always being adjusted to that you can never really understand or see. To me, this really goes down to the idea of, are we in a new regime than pre-pandemic in terms of inflation, or are we not? And that ultimately is a tension underpinning people's interpretation of what the bond market currently is pricing in.
You'll love this quote from Lisa Shallett over at Morgan Stanley. You might have seen it. Equities are pricing in an immaculate soft landing. Bonds, for their part, have rallied aggressively, suggesting recession and intimating that the Fed is behind the curve. Lisa essentially saying that if bonds are right, earnings get hit, and if bonds are wrong, higher rates will create headwinds for valuations. So it's like lose-lose in the equity market, according to Lisa Shallett at Morgan Stanley.
After win-win for so long, and really ultimately that's the key question. Do you end up with so much price to perfection type of activity in markets that there is sort of a downside risk that is disproportional, not because the economy is about to fall out of bed, but just because people are full of hopium? Full of hopium in this equity market. That move in bonds, yield to lower, has unlocked another leg of dollar weakness. We've had 4 days of it on DXY. The euro just a little bit firmer here, 111.36. The fact that we're even close to unchanged on euro dollar in the face of some of the data we've had in the last 24 hours. I know that we don't pay much attention to the ZEW investor expectations out of Germany, but they're kind of rock bottom in Germany at the moment. Are we sitting here and saying that the bar's so low now it's easier to beat? Is that the argument for the euro? I mean, Jeff, you is basically talking about how dollar positioning was just so aggressive that anything that signified that Europe wasn't falling off the map means that it's positive. But there are signs, and he pointed this out too, that structurally there are aspects of the European economy that are falling off the map. And that German ZEW, I'm not going to call it ZEW survey that came out this morning fell it's the lowest in almost a year, and really highlights how both the headline data and the structural headwinds really are significantly pointing to weakness. That's a slip, forgive me. ZEW. Under surveillance this morning, the Secret Service acting director saying agents did not search the perimeter of Donald Trump's Florida golf club before the former president began his round on Sunday. The FBI saying the gunman, who was spotted aiming a rifle in Trump's direction, spent almost 12 hours near the course.
Well, this is the big question that now everyone is talking about. One, was the Secret Service aware that Donald Trump was going to be golfing that day, or was this kind of last minute? You have the Secret Service acting director saying yesterday the president wasn't even really supposed to go there. So was there enough time for them to make sure that they did a proper sweep of the perimeter? And second, this is going to be not even a fight in Washington. Everyone is lining up. They think the Secret Service needs more money, things like drones, things like more individuals on the ground, and they need to get it done fast because we are 7 weeks today from the U.S. election. And we also need to understand exactly how to surveil potential lone wolves, or understand what their motivations are. Are they lone wolves? Are they being, are they part of something else? We don't have a sense of any of that. How can that be after months, 2 months after the first attempt? How can we not have any of that information at a time where ostensibly we have a bigger data collection unit than ever before in terms of being able to mine data to get clues? There's a word we've said repeatedly over the last 2 months and a whole lot more in the last 24 hours. Shocking. Just absolutely shocking. Let's turn to this story. Amazon CEO Andy Jassy telling staff to expect to return to the office 5 days per week, effective at the beginning of next year. The company also planning to simplify its corporate structure by having fewer managers in order to, quote, remove layers and flatten organizations. 5 days a week at Amazon from next year. And this comes at a time that they're not alone. We've seen a lot of companies do this. We've seen Google do this. We've seen the banks do this. They have a hotline that people can call to report inefficient processes that they have to go through to try to weed out some of the managerial oversight and some of the extra layers that have come into play. There is this frustration with size, and we have seen this repeatedly with a number of companies. Interesting to see how they evolve with this and where they're targeting, whether this is the cloud or whether this is more broadly. It's been interesting to see how they use the return to work policy, return to office, because of course they're working at home, return to office, just to be very clear about that. That policy is almost a filter them to self-select ahead of the end of the year conversations, start of the year conversations about who's going to stick around for another 12 months, don't you think? That's a fascinating take. I've felt that way about tech firms now for the last couple of years. That's been the push. Self-select. Do you want to come back or not? And the people that do stick around, and the people that don't, there's going to be a list of them. You select who's going to stay, who's going to go. If you take it a step further, this really points to this idea that maybe it's sort of peak employment, and there is this feeling of a desire to shed some workers. You've seen this in other places too, but there isn't that same leverage of the employees that we saw for a long time. So regardless, that's sort of an interesting takeaway. Gone are the days where the first-year analyst at Goldman Sachs comes out with a PowerPoint presentation about being stressed at work. Right? Do you remember those days? Stressed at work and needing a pay rise. And the banks were coming out and saying, yes, 150 for you, 150 for you, 150 for you. Please stick around. My PowerPoint was really good. Did you do a PowerPoint presentation? About how stressed I was. For management and human resources? Why aren't we working from home? Did you fail? Hi, here I am. Your PowerPoint presentation no good? Yeah, should have seen TK's PowerPoint presentation. I think he asked for per diem for lunch.
Is that what he wanted? I bet, on a regular basis.
Bow tie wax.
Sure. Let's turn to this one. Bank of America's Global Fund Manager Survey showing investor sentiment rising for the first time since June. Participants seeing a 79% chance of a soft landing, but nervous bulls are showing caution, with risk appetite falling to an 11-month low. Alaska Lou of Bank of America Securities joins us now for more. Welcome to the program, sir. It's good to catch up with you. Let's just start with this phrase, nervous bulls. What speaks to you in this fund manager survey that tells you that ultimately they're nervous?
Morning. Look, it's great to be back here. Look, nervosity was palpable across some of the key metrics that we look at every month in the Global Fund Manager Survey. Take, for instance, the risk appetite. About a net 23% of FMS investors said that they were taking lower than normal risk levels at the moment. We also have the FMS Financial Market Stability Risk Indicator, which is this blended measure of risk indicators, which rose to an 8-month high. You also look, for instance, at the desire for greater payouts. This rose to the highest level since 2013. And finally, just look at the extent of the rotation out of cyclicals and commodities into bond sensitives and defensives. This one was one of the most brutal rotation in the 25 years of the Global Fund Manager Survey. So yes, there is palpable nervosity, and maybe the best illustration of this apparent nervosity is FMS positioning on commodities. FMS investors slashed their exposure to commodities and are now the most underweight the asset class since June 2017. And that's why we say that investors are nervous bull into the fall.
That commodity position speaks to why we've got this biggest underweight on energy since December 2020. Just to sit on the sectors and go through some of the overweights and underweights elsewhere. Overweight utilities by the most since December 2008. The biggest overweight on banks since February 23. The most overweight on staples since September 23. Can you walk me through what's offensive and what's defensive in those sectors? Utilities, I'm told, are defensive by some, but by others they are more offensive given this tie-up with AI more recently. Banks, I don't know if banks are meant to trade higher on higher rates or on lower rates anymore. And then you've got the likes of staples, which typically is very defensive. What does that sector mix, those preferences tell you?
Look, I mean, yeah, you're absolutely right. You know, we decided in this survey that we would consider utilities, staples as the classic defensive sectors. At least these are perceived by our FMS investors base as the defensive sectors. Remember, these are global sectors and not just only US focused. And clearly, when you consider the average net overweight on utilities and staples on one side, and on the other, what you can easily perceive as cyclical materials, energy, but also industrials, this one of the most rapid month-over-month shift into defensives, led by utilities, as you said, the most overweight utility stocks since December 2008. And on the other hand, the shift out of cyclicals was driven by commodity sensitives. But if you also consider tech as a cyclical sector, FMS investors have cut their allocation to tech stocks to only net 3% overweight, which is, by the way, the lowest since April 2023, when we first started to record that long Magnificent Seven as the most crowded trade, which still is this month.
Elias, how do people normally look at the Bank of America Fund Manager Survey? Is it a contrarian signal, or is it a leading indicator of where investors are putting their cash?
I think it depends on the category of investors, but most view it as a contrarian survey, because at the the FMS Global Fund Manager Survey is great at building a narrative on sentiment and positioning and seeing how the consensus has evolved. Today, there's clearly been a defensive tilt in positioning through the summer. This is how FMS investors have weathered the summer vol events in July, in August. They have shifted into utilities, but also into bond sensitives, and that's related to the big expectation regarding rate cuts. In fact, we just just recorded the biggest share of investors expecting lower short-term rates in the next 12 months. 93% of them expect lower short-term rates by this time next year. And on the other hand, it's great for developing a contrarian view. If you are a contrarian today, you would actually be adding to commodities, to anything that's China sensitive, energy, commodities, but also cyclicals and REITs in particular. So that's how we form the contrarian view.
Yeah, next level contrarian when you start going heavily into China, considering the current sentiment. Another aspect in terms of if you really feel bold, 90% of recipients expect yield curves to steepen. That is the most on record. This comes at a time, exactly to your point, everyone's expecting short-term yields to go lower. How many people are pushing back in any way, shape, or form and expecting a flattening yield curve? Or, I mean, is that something that people are even thinking about, or does this really hint at this concern that maybe there is too much complacency priced in about what the Fed is willing and able to do with rate cuts?
Of course, I mean, if you are very bullish on a global economic soft landing, you are very bullish on the fact that inflation will slow, that central banks will be able to deliver swift easing cycle and rate cuts in the next 12 months. And that's how you position in favor of a steeper yield curve. But the big steepening has happened already. I mean, you discussed that just before our discussion, right? The bond market is pricing, it depends on the day, but between 200 and 250 bips of cuts in the next 12 to 15 months. That's a lot of cuts. And you see why we considered this survey as a nervous optimistic survey, because it's so reliant on Fed cuts. And the big risk is if the Fed does not deliver in terms of expectation, that's where the big risk lies as of today.
Elias, you mentioned China. How concerned are investors about the macroeconomic outlook coming out of Beijing?
Sure. I mean, we're talking about the world's second largest economy, and FMS macro sentiment on China just hit the lowest level in the past 3 years. In fact, since we started asking about China growth expectation. So China has clearly been one of the major factor in weighing down on the sentiment this month. But the bullishness on the Fed, the bullishness on the soft landing have been able to outweigh the pessimism on China. And that's why the overall FMS sentiment rose for the first time in 3 months. And this whiff of optimism on the other end allowed for lower FMS cash allocation. Investors started to deploy cash for the first time in 4 months. And we think that's a contrarian positive in the near term.
Interesting. Elias, always great to catch up with you at Bank of America. Thank you, sir. Elias Galou there, Bank of America. Global research on the Global Fund Manager Survey. The title of this month, The Contrarian Play, Commodities. Commodities is not where the money is right now.
No, you saw allocations drop to the lowest, I believe, going back to 2007. Something insane as people really look to what we have seen, which is weakness, even in the face of a resilient economy. This is weakness that comes with the transition to electric vehicles, as well as the weakness in China that very few people are willing to really get ahead of.
Brent Crude, just about in the 70s. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Staying on commodities, Goldman Sachs predicting gold could face a minor near-term setback if the Fed decides to cut rates by only 25 basis points tomorrow. But the analysts then see it rallying to a record as money flows into gold-backed ETFs. Spot gold is currently trading at around $2,575 an ounce. Goldman expects it will surge to $2,700 an ounce by early next year. Meanwhile, the Harris campaign is gearing up for a rare, high-profile fundraising event in Manhattan. The event is being billed as the final chance to see Harris in New York before the election. Tickets for the event go for $500 to $1 million, with the top buyers given access to additional exclusive events. Harris has built a large cash lead over Donald Trump, raising $361 million in August, nearly 3 times what the Republican nominee reported. And Stanford University topped the Bloomberg Business Week rankings of the best business school for the 2024 to 25 academic year. This marks the 6th straight year Stanford takes the top spot among full-time MBA programs at U.S. schools. The Palo Alto-based university maintains strong scores in 4 of the 5 areas we index, including compensation, learning, networking, and entrepreneurship. Rounding out the top 5 were Chicago, Northwestern, Dartmouth, and Virginia. That's your Bloomberg Brief. John?
Very cool. Yahira, thank you. More from Yahira in about 30 minutes. Up next on the program, waiting on the cut.
We'll see what the market does. There will be 3 cuts of 25. And at the end of the day, what matters is where we are at the end of the year.
A conversation just around the corner from New York. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
New lows for the year on a 10-year yield in today's session. That low for 2024, 360. That's where we trade right now. Going into this Federal Reserve decision, we're down a single basis point. The 10-year, 360.26. Under surveillance this morning, the Fed's 2-day meeting begins.
We'll see what the market does. It may very well be that it doesn't make that much of a difference. There will be 3 cuts of 25. And at the end of the day, what matters is where we are at the end of the year. I think people have been very much on the sideline rolling short-term treasury bill. And this money will get redeployed. And how fast and how remains to be seen.
So here's the latest. Treasury's holding steady with traders awaiting U.S. retail sales data in about 40 minutes' time. Then it's all eyes on tomorrow's Fed decision with rate cuts all but certain. Katie Kaminsky of Alpha Simplex saying fixed income markets have already priced in cuts through the end of the year. The yield curve is steepening in anticipation of rate cuts. And the real question isn't cuts, it's what happens after cuts. Katie joins us now for more. Katie Kaminsky, let's get to the first question, the only question we always have for you to start any conversation. Are you still long this bond market?
Yes, we're still long bond markets, and bond markets have been one of the biggest themes recently and one of the best trades this month. I'd say that what is interesting about that is that we're positioned very defensively outside of equities, which has me thinking.
Okay, have you thinking about what? That if you're positioned outside of equities, what's your positioning? What's sort of the shift in momentum that you're looking for?
So what's really interesting right now is that when you look in cross-asset themes, you see long fixed income, short commodities, short the US dollar, and that is very defensive, which is why I'm so focused on cuts, because once we have cuts, the question is, are cuts motivated by inflation going down, or could cuts be slightly motivated as well by some of the economic weakness that we've seen recently? As we move into cuts in a period where we're not in a recession, what does that mean for markets after cuts occur? If cuts occur and they stimulate the economy, we could have to start talking about inflation again, and that becomes the risk that we're worried about.
So what are you looking for in terms of a trigger? Is this basically, are you looking for reasons to potentially get more bullish on risk assets if you do get some sort of cuts proactively? Or could you see a reversal of what we've seen, which is basically everything going down because bonds are losing value on inflation risks that are new, and stocks maybe have been overpriced to the price to perfection with rate cuts?
Exactly. And I think the challenge is if we have really aggressive cuts and then, of course, we see that we have a little bit of a pullback, then we're going to see a repricing in the fixed income curve, which I think would be the idea that it will take longer to get to lower rates than people would have expected. So that would be a repricing. I'm also concerned about the commodity sector, which has been a very, very strong short signal since early this summer. If you start to see economic activity tick up again, that could be at risk for bottoming out and starting to reaccelerate. So I think for us right now, given we're defensive in positioning, that's going to be positive for equities, but there are new risks that will have to be examined as soon as we move into a new cycle.
But Katie, doesn't the fact that China is slowing down, we just had the Bank of America fund survey representative on talking about the fact that the contrarian trade is in commodities because they're doing so poorly, doesn't that really quell these concerns about inflation reaccelerating?
It does in the short term, but I think the challenge is the timing on that. If we start to see the economy reaccelerate, or if we started to see China reaccelerate in some way, then we'll go back to that inflation narrative that we were worried about earlier this year. Right now, cuts definitely seem justified, and it's a positive thing if cuts are coming because inflation has disappeared. If there's any semblance that cuts are coming because of potential economic weakness, that's where the defensive story makes more sense.
Katie, can we finish on a point of potential tension? As we speak, the 10 and 30-year yield are at or close to the lows of the year, and at the same time, gold is very close to all-time highs. Is there some tension there that needs to be reconciled, resolved?
Of course, because I'd say that, looking at gold has really been a play on the potential concerns of inflation throughout the year. And the fact that gold continues to be strong means that longer term expectations of inflation is what might be more unclear. Shorter term, yes, it looks much better given what's going on in China. But if you look at the 10-year yield and you look at the long-term bonds, if we start cutting rates and we start seeing potential for inflation again, you could see a further steepening of the yield curve, which would create a repricing for those that have locked in rates in the long end of the curve.
Potentially a steepening that's led by the long end selling off, Katie, which is what I think you're alluding to, and we need to breathe a little bit more oxygen into. Can we talk about that? If this Fed outdoves this market tomorrow, does that long end sell off?
It's possible. I mean, think about it. When you think about inflation, if inflation expectations change because of an aggressive Fed cut from the Fed, then what you're going to see is that repricing of long-term inflation expectations. Remember, we're still above target and we're cutting rates. So if we cut rates aggressively and inflation expectations tick up, that means that longer-term bonds will have more vulnerability, and we'll see different correlations between stocks and bonds, something that we've been dealing with for the last 2 years.
Interesting. Super thoughtful stuff. Katie, thank you. Katie Kaminsky of Alpha Simplex on this bond market. Up next on this program, third hour of Bloomberg Surveillance just around the corner. We'll catch up with Keith Lerner of Truist, Pierre Farragut of New Street Research, Blarina Nurici of T. Rowe Price, and Ashok Bhatia of Neuberger Berman. Retail sales 34 minutes away.
To succeed in Wall Street,
yeah.
What skills do you need? Do you need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time? What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative. At a time, nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The Fed is going to be cutting into a pretty good economy, and we don't have a lot of benchmarks for what that looks like.
The market realizes that either it's a hard landing or it's a growth scare.
We're really not sitting here in a position where we can absorb any kind of bad news easily.
The data, as of the last few days, has not been sufficiently weak to convince them of a 50 basis point rate cut.
There will be 3 cuts of 25. And at the end of the day, what matters is where we are at the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So let's talk about how we're set up this morning, and good morning to you all. Equity futures advancing by 0.4%. We're looking at a 7-day winning streak on the S&P 500, potentially. On the NASDAQ right now, advancing by 0.6%. On the Russell, up by 0.6%. Bond yields near the lows of the year on a 10-year and 30-year. We're down a basis point on a 10-year, down 2 on 30s, 360 and 391 respectively. On a 2-year, up a single basis point at 356. All of this going into this at 8:30 Eastern Time. U.S. retail sales very much in focus for everyone, taking on extra emphasis as this two-day Fed meeting kicks off?
This highlights the volatility that we've seen almost after every data point at a time, where we're hunting for narratives, and the Fed is too. Key question to me will be, what will sort of respond more, the bond market or the stock market, considering the fact that a lot of people are saying that a 50 basis point rate cut is baked in regardless of what retail sales show.
Do you find it odd that for about 2 months now we've been told that good news is good news and bad news is bad, and ultimately to get 50 basis points tomorrow sealed, you need a bad retail sales print at 8:30 Eastern Time? Do we know if that's good or bad for equities?
The fact that you're asking this question, to me, highlights the uncertainty of, frankly, the Fed reaction function, as well as what's on the line when it comes to 50 versus 25, and what it really matters in terms of the longer-term projection. There was this uncertainty that was sort of introduced into the market by a series of articles in the Wall Street Journal and Financial Times that some people thought of as maybe indications that this was a Federal Reserve that was more inclined to cut by 50 basis points than 25.
That's what Andrew Hollenhorst of Citi is saying. He said markets pricing in and out 25 or 50 amid no clear guidance because of this uncertainty, this ambiguity that was really addressed into the market because of what happened with the Wall Street Journal and the FT. So now you have to start thinking about, I guess we need to think about that one more print for the totality of data. And just because it's the proximity of it on the day that the Fed is going to be gathering makes it so important.
We've got to be careful with the language. No clear guidance. We've had guidance from FOMC officials. They just didn't clearly guide us to a 50 basis point rate cut. We've had guidance from them, though. Pretty clearly, they want to reduce interest rates, and pretty clearly, there's a bigger debate about the size of that.
We don't have a sense, though, about what the destination is, and they talk about the importance of understanding the path of the destination and the destination with respect to where rates will end up. We also don't understand how much their mandate has shifted. We did hear a different tone from Jay Powell at Jackson Hole talking about how no further weakening in the labor market would be welcome in any capacity. At what point does that lower the bar to such a degree they might as well get those rates closer to that elusive neutral as quickly as possible?
Remember going into the payrolls report and we said it'll all be settled after payrolls, 25 or 50. It wasn't. It'll all be settled at 8:30 Eastern Time after retail sales.
They'll be banging line.
We'll see.
Well, nothing
exactly.
will happen.
How problematic would that be?
Absolutely. Everyone's going to just fluctuate, and then we're going to be talking about, are we positioned for buy the dip, sell the news?
Whose voice is that?
I don't know.
It's like a hint of TK. Equity futures look like this on the S&P 500, advancing just a little bit, looking for 7 days of gains on the S&P 500. In the bond market, yields a little bit lower, down a basis point, near the lows of 2024, 360.82. Coming up this hour, we'll catch up with Keith Lerner of Truist as investors await retail sales data, Pierre Ferragu of New Street Research as Apple shares slump on iPhone 16 demand worries, and Bruno Ricci of T. Rowe Price on the 25 versus 50 coin toss. We begin with our top story. Stocks higher ahead of retail sales, the final data point that could dictate the size of tomorrow's Fed rate cut. Keith Lerner of Truist saying our base case is the bull market trend remains intact, yet the choppier waters we have been writing about are set to continue. Keith joins us now for more. So Keith, let's begin with 8:30 Eastern Time, and welcome to the program, buddy, as always. What are you looking for at 8:30 in retail sales?
Yeah, well, great to be with you. I think it's unbelievable that this is the most important retail sales ever. I don't know that it's going to be that much different than expectations. Maybe on the margin it makes a change, but I think as we look at this morning, the Fed funds futures is pricing about a 67% chance of a Fed rate cut. I mean, they're giving the Fed the opportunity if they want to take it. We think they should. You just talked about, I heard Lisa talking about where they're at neutral rate, wherever that neutral rate is, it's far below where it is today. And as Fed Chairman Powell has mentioned, their focus has shifted to employment, and you're still about 5.25 to 5.50 on the Fed funds. So we think they should take what the market's given them.
Keith, let's talk about positioning going into this, how long this equity market is. We're close to all-time highs. In the bond market, yields close or at the lows of the year on yields for 2024. Keith, with that in mind, if the Fed validates the dot plot, validates market pricing, if that's all they do, and they fail to outdove this market, how vulnerable is market pricing in both stocks and bonds?
Yeah, we are at an inflection point. If you look at the S&P 500, we're within a 1% of an all-time high. So you're at a critical technical level. If you break above that, you could have actually some technical traders come in. So, I think it is important as far as not only the cut, the dot plot, but also importantly is what Powell says, and we expect him to be more on the dovish side, but I think we are at a critical short-term point based on the charts alone.
When you talk about the inflection point, you're talking about the overall index. I would argue there's also this inflection point when it comes to this rotation trade that's fueled a lot of the recent gains and fueled the equal weight S&P 500 reaching its all-time high. How much is that really what's at stake here, or whether the Fed is going to support that with an outsized cut?
Yeah, well, the S&P equal weight index, as you mentioned, just hit an all-time high, but we also have to recognize that index is less than 10% above where it was in 2022. So it's not like it's been way ahead of itself. It traded sideways for a long time, and now this rotation trade has come in, helped the equal weight index. We saw industrials make a new high yesterday. Financials are close to a new high. So, and then we have the advanced decline line for the S&P also at an all-time high. So I think if they're less dovish than the market anticipates, then you would see some money move out of there. I mean, either way, we still like tech. I know tech's has been struggling here more recently. We actually upgraded it during the August pullback. But if you have a cooling economy, which we think continues regardless of what happens with the Fed tomorrow, and we're seeing earning trends in tech still stronger than the overall market, we think money eventually moves back there in the fourth quarter. But at this point, again, I think the rotation trade, likely, I think you'll see participation. But I do think if you have a less dovish press conference, then you would likely see that kind of stall out.
Keith, I love that you're trying to do scenario analysis. We're all trying to do scenario analysis. We're having the fun game of 25 or 50 for the past couple of weeks. There is this issue of at what point do you just buy tech? And that's basically what you're going into. How much is that because of some of the recent sell-off, the fact that it's been lagging behind, and how much is it because of moves like what we saw with Microsoft actually increasing its dividend, albeit to still low level? But in some ways, this is the new income play?
Yeah, maybe it's an income play, but I think in general, you're thinking about, an economy that's cooling, right? We can debate, some people are saying recession, that's not our base case, but we can agree that it's cooling. And in a cooling environment, I think investors will eventually continue to pay a premium for companies where there is growth. And as you mentioned, where things can be done on the balance sheets or income statements as far as, buybacks and dividend payments. So tech has a bit of both. And the other thing, during the correction in tech, we have not seen any kind of weakness in the overall technology earnings side, which would make us more nervous. And then also for just, a little bit of context, over the last 3 years, tech is up, around 50 to 60%. During the technology bubble, into that technology peak, it was up over 350% on a 3-year basis. So we don't think we're in bubble territory, and we just think that we have an uncertain environment, and in that environment, you go through where these companies are generating huge cash flows, have strong balance sheets, and I think that AI story is still relatively early.
Keith, I think you've touched on a part of the market, part of the story that people are having difficulty with. Keith, typically, as growth starts to decelerate and rates come down, that would present an argument to go into some of those tech firms that you've just described. But Keith, at the moment, we're having a conversation about slower growth, lower rates, but rotating away from those names and going to places that typically are associated with better growth and higher rates, banks. Keith, can you walk me through the kind of beneficiaries in this equity market? Who benefits, who struggles with lower interest rates in the 18 months ahead of us?
Yeah, so I think I think part of what we're seeing is also just a reflection of what position was. If you think about heading into July, I mean, tech got overextended and position was overdone. And on these other areas, as I mentioned, the equal weight index hadn't done much. Financials had lagged. So I think part of what we've seen, even though it kind of seems counterintuitive, is just kind of a repositioning. If rates come down, we're also overweight utilities. Believe it or not, we're overweight utilities and tech. So I think some of those defensive areas likely continue to work. What areas get hurt by rates? I don't know that many places get hurt. I think it's who benefits more. On the margin, small caps would benefit more because obviously the floating rate debt. Our position, though, is we still longer term like large caps more, because in order for small caps to really outperform on a sustainable basis, you really need to see that growth accelerate. And that's not our base. I will say, just an interesting discussion. We talked about scenario analysis. It's not our base case, but no one's talking about a potential of a re-acceleration really in the economy. I shouldn't say no one, but majority of folks aren't. And you do have the dollar that has come down quite a bit. You've seen oil prices come down quite a bit as well. So that would be the case where you'd see these other areas really, really pop. Now again, not a base case, but maybe something to think about.
Well, just to build on that, Keith, and just to underscore the fact that Katie Kaminsky was making that point just a minute ago, at what point do you get underweight longer-term bonds at a time where a lot of people are seeing very little upside gain going forward based on the fact that we've hit the lowest going back a year?
Yeah, well, we were excited about bonds when they were around 450, 460. We were actually long duration bonds. We cut that as we moved below 4. At this point, on a shorter term basis, I mean, I think, you know, even in a really diverse scenario, maybe you go down to 325 in the 10-year. That's where we were close to during that mini financial crisis we had over a year ago. So, I mean, you know, when you look historically after the first rate cut, the 10-year tends to move down over the next year, whether you have a soft landing or a hard landing. So I think ultimately yields move lower. I think on a short-term basis, they've moved so much in a short period of time. I just don't think the risk-reward is that compelling after this move.
Hey, Keith, good to get your thoughts. As always, Keith Lerner of Truist going to a very finely balanced Federal Reserve decision tomorrow afternoon. The last time we had this kind of tension, I'm thinking back to maybe spring of last year, where we had the bank stress and we were wondering whether they would pull away from hiking interest rates, and they still hiked interest rates. And I wonder if that's a sign of how confident this Fed might be, how convicted it might be about the decision they've got to make tomorrow.
On the other side, to basically cut rates by 50 basis points, even if you get a robust retail sales number. So we'll have to see how stocks really respond to the retail sales print, which is going to be shocking.
The most important retail sales print ever in the history of financial markets at 8:30 Eastern Time, just around the corner. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. Iraq's prime minister telling Bloomberg that U.S. troops are no longer needed in his country, saying they've largely succeeded in vanquishing ISIS and are moving on from wars to stability. Around 2,500 American soldiers are still based in the country, part of a coalition formed in 2014 as ISIS was still gaining ground. Iraq has said it wants a full U.S. withdrawal by 2026, but the White House and some U.S. politicians remain wary. Meanwhile, parts of Central Europe are bracing for further damage amid the region's worst flooding in 2 decades. Residents in parts of Poland and the Czech Republic have been evacuated as heavy rains continue and water levels on the river Danube rise further. In Austria, the focus is turning to melting snow and landslides after the slow-moving cold weather system brought heavy snowfall to the Alps. At least 17 people have died across several countries over the past several days. And Donald Trump is putting the spotlight on the crypto sector, unveiling a new platform dubbed World Liberty Financial. The Republican presidential nominee has courted the digital asset space in search of donations and votes amid a tight race for the White House. In a live stream on X yesterday, Trump pointed to competition from China, saying the U.S. could fall behind in the race to become the world's crypto hub. The over 2 hours event was light on specific details about World Liberty Financial or when it might go live. That's your Bloomberg Brief. John?
Yahara, thank you. How many times have we had conversations about policy from both the Democrats and Republicans and then sat here and said, light on details, light on specifics?
This has been basically the theme that we've had for 2024. It's not unusual, but it seems as though it's on steroids this year.
Light on details about when this World Liberty Financial token would come into light, and does it have anything to do with how the former president feels about the crypto industry if his sons are going to launch this token?
That phrase defining the campaign so far in 2024. Up next on the program, the Morning Calls Plus, Pierre Ferragut of New Street, as weak iPhone 16 demand puts pressure on Apple. That conversation just around the corner. Your retail sales print 15 minutes away with equities just off session highs.
There is this real momentum from Wall Street.
We are basically
especially deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Looking potentially at going into this Fed decision at all-time highs on the S&P 500, close to, potentially yields at the lows of the year for 2024. As this two-day meeting begins at the FOMC, they're waiting for one more data point, 8:30 Eastern Time. Retail sales just around the corner. Your 10-year yield, 361. Your equity market positive, 1/3%. Let's get you some morning calls. First up, Redburn Atlantic, upgrading Shopify to buy, expecting the company to benefit from a social e-commerce boom in the US. That stock is up 3%. Next up, Bank of America upgrading HP Enterprise to buy, seeing numerous upcoming catalysts at an attractive valuation. That stock up by 3.7%. And finally, JP Morgan lowering its price target on Qualcomm to 210, expecting earnings to be impacted by the loss of Apple revenue. That stock is up by 0.65%. Let's stick with Apple. Shares slumping close to 3% in yesterday's session on iPhone 16 demand worries. Pierre Fadigo of New Street Research saying there's no game-changing hardware. A product cycle is unlikely. Apple claims iPhone 16 is built from the ground up for Apple Intelligence, but the reality is that the A18 improvement over A17 is more incremental than revolutionary. We maintain our cautious and neutral views on Apple. Pierre joins us now for more. Pierre, that line you've got in your research, and welcome, sir, as always, a product cycle is unlikely. So, Pierre, are you saying even when they've got the software, the goodies ready to go, that upgrade cycle's not coming?
Yes, I think if you look back in June, Apple announced their AI plans, like Apple Intelligence, and that got everybody super excited because I think it's true that the potential of AI, generative AI, really revolutionizing your user experience on an iPhone is very, very high. But now you need to look at the products, and the products are like it's hardware, it's evolving every year. Apple has been actually evolving its hardware to enable AI already for quite a few years. And we are like on a very linear trajectory on that front. And the iPhone 16 is not like a significant leap forward. And so like the benefits of AI are really going to be software defined, software driven. It's going to be about Apple releasing software, releasing new features and getting them into the hands of users. And over time, you will see these features maturing into great use cases, and it could have a very positive impact on Apple, be it a product cycle or new ways to monetize users. But all these things are going to take quite some time because for the moment, AI is still, a trial and error kind of process. Apple has already released a lot of the software. And this software is completely fine and operating on the iPhone 15 Pro. Yeah. And we already have feedback from users. And the feedback is, I think the right way to qualify it is lukewarm. People appreciate the new features, but there is no like revolutionizing use case or killer app yet. So we need to give it time for Apple to figure out, how they can revolutionize the iPhone user experience with Apple Intelligence. And this is not going to have any effect on the near-term demand for the iPhone 16. Yeah. And on the contrary, the risk we see is that people are like kind of seeing significant, innovation coming through and might actually be on the wait and see kind of line. And so, if anything, I see a negative risk on the iPhone 16 cycle.
Well, there are two things here. A question of whether you should give Apple time to get it right, or whether they are losing market competitiveness because others are getting in on the game at a more aggressive pace. Is this just that people are pricing in the upgrade cycle too soon, or that it isn't going to come because of some of the competition?
Yeah, it's a very good question, and this is really not the latter. It is the former. It's just like we have the exact same perspective in the PC market. Everybody is getting excited about AI PCs, and our view is that you don't have yet use cases that would justify a product cycle driven by the new hardware of AI PCs. And in the rest of the smartphone market, we see a very similar situation. So Apple is absolutely not lagging behind on hardware. They're still at the forefront of the industry. Their hardware is exceptionally good. There is no worries there. The one thing I could say, though, is that today, when you look at very fast growing user bases and growing use cases and killer apps emerging, you see them with the like of Perplexity AI, OpenAI, or XAI and Grok on X. So for the moment, AI is making progress outside of hardware companies. So that's one thing you want to keep an eye on. Is Apple really going to be able to offer a very strongly differentiated AI experience because they own the hardware, or actually are OpenAI and Perplexity AIs and other similar players going to have control on the technology because they're innovating faster on the software front and on the service front.
Pierre, what do you make then potentially of a better cycle for the iPhone 17 when you would get this marriage of the AI software and new hardware?
Yeah, I think it's especially, if the iPhone 16 revealed itself in the end disappointing. The weaker the 16 will be, the more positive I will be about the 17, for sure.
Excitement postponed. Pierre, thank you, sir. Pierre Ferragut of New Street Research on the latest iPhone. Some real concerns in the last 24 hours about what pre-orders look like and what the first quarter is going to look like for this new iPhone.
Yeah, with some signs that maybe it's a good 10 to 15% lower than what it was this time last year, even right before the holiday season. And that's really the issue, is that this is when they have to be getting that robust sales kick to really make the sort of profit targets that some people are looking for.
Throwing cold water on the Dan Ives thesis as well, right, over at Wedbush, looking for that golden upgrade cycle, that big story we've been waiting for a number of years now. I've heard that argument for a number of years. Now, the fact that it hasn't materialized hasn't held back the stock, so I think we have to mention that, but it hasn't materialized.
And that's coming at a time when they have been slightly behind when it comes to the AI technological rollout and also the folding prowess that some have really managed to nail home.
Not buying that, are you?
Well, I just think that until you get good screws that can make the actual connections work. I mean, if it starts to break apart, the more complicated a phone is, just mechanically, the more things can go wrong. That's what I'm learning.
So you're not ready to buy the folding phone just yet?
I mean, I like the idea of a bigger screen. I don't like the idea of someone's calling you being like, oh, wait, hold on a second. Let me get this.
How thick is this thing?
I don't know.
Anyway. All right, up next, the big one. Retail sales, the last key data point before the Federal Reserve decision. It's exciting stuff. It's 8:30 Eastern time. It's just around the corner. Reacting, we'll catch up with Blarina Urucci of T. Rowe Price, Ashok Bhatia of Neuberger Berman here to react, and Michael McKee here to break the number. Retail sales just around the corner, and for many of you, the difference between 25 and 50. We could settle that debate in just 5 minutes' time. Let's see if we will. The data drops next.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Here it is, retail sales, 24 seconds away. Your scores look like this on the S&P 500. We are positive by 0.4%. On the NASDAQ 100, up by 0.6%. The Russell of small caps adding some weight to the recent rally, up 1/3 of 1%. The scores in the bond market yields near the lows of the year for 2024. 360 on a 10-year. On a 30-year, 390.53. We're down about 2 basis points at the long end. With your economic data, here's Mike McKee. Good morning, Michael.
Good morning, John. Well, the U.S. economy appears to be doing a little bit better than people anticipated as we get a 0.1% rise in retail sales overall. The forecast was for a 0.2 decline given the low number of automobile sales last month. But retail sales ex-autos comes in at 0.1. Retail sales ex-auto and gas 0.2. And the retail sales control group matches the last couple of months with a 0.3% rise. So all of this, with the exception of the headline, is basically what was anticipated in the markets, and it's probably, John, not going to answer the question you posed just before the break of whether this pushes them to do 50 or 25.
It settles absolutely nothing. Mike, that's how we started the hour. We said, remember going into payrolls when we said this is the one that will settle the debate, and then it didn't. This is the one that will settle the debate, and it hasn't. At the front end of the yield curve, yields are still up by, let's call it 0.5 basis point. At the longer end of the curve, we're still down about 2 on 10s. On 30s, we're down 2 to about 390 on a 10-year at the moment, 360. I'll show you how the equity market's responded to this. Equity futures shaping up as follows on the S&P 500, the NASDAQ and a Russell. On the S&P up by 0.4%. Similar move on the Russell. The NASDAQ basically as you were, up by 0.6%. And dollar yen has hardly moved. Check out an intraday chart of dollar yen, 140.79, basically unchanged on the session. Lisa, this one has settled absolutely nothing about 25 versus 50.
And that was the most important retail sale in the history of financial markets. Look, this is the real point that we have here. Everyone's looking for clarity at a time where there isn't that to be had. Whether the Fed uses this as a reason to cut 50, not likely. However, will it dissuade them from going 50 if they already had indicated they wanted to? I don't know. I'm looking for dissents.
Michael McKee, walk me through what you're looking for. What this committee conversation looks like that starts today and concludes tomorrow.
Well, the committee is basically going to make its decision on whether it thinks the economy needs the extra stimulus, that we are too far above neutral and still too tight. This number doesn't suggest that, although some of the underlying figures do. There are a lot of negative categories this month, somewhat surprisingly, including food and beverage stores, grocery stores. Some people had thought that everybody was just cutting back on everything else to spend on food and grocery stores, but they're down by 0.6 and 0.7. Clothing stores are down, and August is supposed to be a back-to-school month, so some odd stuff there. The big gainer, non-store retailers. The internet is the one that improved the most, up 1.4%. So it looks like at this point, Americans are still hanging in there, but they're being a little bit pickier about what they're buying.
And there's this real feeling that this confirms what we've heard from a lot of companies in terms of the forward look. Does this sort of remove any indication of any reacceleration in the economy or a risk that that is something that should be a preeminent concern for the Fed? In other words, does this do anything to dissuade people who already wanted to cut by 50 basis points from doing so?
I don't know that it dissuades people. They can make the argument that there were a number of categories that did see negative results over the month, but it doesn't really show the economy overall is falling off. When you look at the control number, which is you take out gasoline, automobiles, and building materials, because they go into GDP in different areas, you still see enough strength that the economy can continue along. And you look at the Atlanta Fed GDP is 2.5%. So it's still hard to make the case that the economy is in need of a cut. The only question is, as has been pointed out, whatever they do tomorrow won't hit the economy until maybe February or March of next year. So they've got to be looking not at what we just saw for the month of August, but what they think the economy is going to be like next year, early next year. And that's a little bit harder to game out.
Mike McKee, stay close. Let's recap this data. 0.3% on the control group. That's the data point that goes into US GDP, in line with expectations at 0.3. The headline retail sales read just a little bit better than anticipated. Remember, 25 or 50. What people were looking for was a weaker retail sales print to cement, all but cement, a 50 basis point rate cut at the Federal Reserve tomorrow afternoon. This settles absolutely nothing. Check out the equity market on the S&P, on the NASDAQ, the Russell. This is what pricing looks like going into the opening bell about an hour from now. Equity futures up 1/3 on the S&P. The NASDAQ is basically where it was, Lisa, before the number. After the number, we're up by 0.6%.
If there is any conclusion from this retail sales report, it confirms what we've already been hearing, which is that companies say that you do have picky consumers, but they're not falling off a cliff. And it confirms that this is still a market that is pricing in a good chance of a 50 basis point rate cut by the Federal Reserve. If that happens, it would be the right kind of cut. At least that is the implication from markets and from this recent data showing that the economy isn't falling off a cliff, but additional stimulus could potentially, or additional easing could potentially give some speed to the rotation and the gains that we've seen in equity.
Which speaks to the rally, as you just said, speaks to the rally in the equity market over the last week and again this morning on equity futures going into the opening bell. To continue this conversation, joining us now is Blarina Urucci of T. Rowe Price. Blarina, let's get to this data. It seems to have settled absolutely nothing about whether we go 25 or 50 tomorrow afternoon. What's your base case now?
So I would say that what we discussed here in the past is still valid, that the Fed is data dependent, not data point dependent. And so I hope when they sit in their deliberations today and tomorrow, they'll look at what we've seen in the economy over the last 3 months. I would say before the quiet period, we didn't have an indication that they wanted to start this cutting cycle with a big cut, but it seems like perhaps we don't have as good a sense of how the Fed is interpreting the labor market data as we should. And so I think into the decision, it's really essentially a coin flip, and I don't disagree with market expectations here. I do think that the Fed perhaps is looking at the fall in vacancy rates, at the recent uptick in the unemployment rate, and the labor market differential from the consumer side of the data, and saying, okay, the labor market is really slowing down, and perhaps we are a bit behind the curve, and we want to take some insurance cuts early in the cycle. So I think it's completely possible that we get a 50 basis point cut tomorrow. And I do think that the summary of economic projections is probably going to show that the dot plot has 100 basis point worth of cuts for the year as a whole. And I think if you consider how the market deals with uncertainty, perhaps from the FOMC's perspective, it makes communication easier. They start with 50 basis points, and then the market can expect at the November and December meeting a couple of 25 basis point cuts.
You mentioned the SEP. Let's start there and we'll unpack the rest in just a moment. The summary of economic projections was last published on June 12th, and that is super stout. So we're going to see some major revisions to that one. You mentioned how the median dot would come down and show in basically 100 basis points of cuts for this year. Blarina, can you walk me through 2025? Where's that median dot for 25?
Right. I think you're absolutely right. We're going to get a much more dovish dot plot than we had in June. Just a reminder, in June, we had only one cut for this year. So the FOMC has really changed their assessment of the economy and of the cutting cycle. For next year, I don't expect changes. I think they're going to still have 4 cuts. It would be a very dovish surprise if they fully embrace market pricing and show 4 cuts this year and 6 cuts next year. It's a risk to my view, but I do think that shifting to 8 cuts over the next 15 months or so, it's already a very dovish move from the side of the Fed. And then if you consider where they had interest rates at the end of the cutting cycle, I think essentially what's happening is they're not changing their idea or their view of the destination and the long run rate. They're just bringing those cuts forward because the cooling in the labor market and in inflation is happening faster than they expected back in June.
Just to sort of build on that, there's this feeling that later this year it'll get that much more difficult for the Federal Reserve to project out some sort of path with potentially some different fiscal proposals that could come to the fore that could very much affect inflation. Do you expect that to be sort of hinted at or suggested, discussed by a Federal Reserve that has hinted about the deficit as well as some other government programs?
I do expect that the FOMC and Powell in particular during the press conference will be asked this question. I think they will stick with their mantra here that they take fiscal policy as given. I do think that they are for sure assessing risks around their outlook with regards to what will happen if we have tariffs across the board. I know that we've had tariffs in the past. It's a one-off shock to the price level, but we haven't had sustained high inflation at these levels for quite some decades. So what will it do to inflation expectations if you have another shock to prices? So I think this will be part of the deliberation. I do think that when they get asked directly about it, they're not going to comment. But for me, I think even setting aside fiscal policy uncertainty, I do have a more benign or optimistic interpretation of data, both from the labor market and activity, than the market seem to have. And I do think if the Fed front loads cuts and easing in financial conditions, that it's setting up the economy to perform quite well later this year and at the beginning of 2025. And I think this will put forward some challenges to them bringing inflation down to 2%.
Is there any chance that there's a risk that this could set up the economy to, besides doing quite well, potentially re-accelerate inflation, Blarina?
I think this is the key risk that people are not talking about anymore. I do think there is too much certainty priced in the market that the Fed is going to bring inflation down to 2%. And when I look at the progress we've made so far on goods disinflation, a lot of that has been driven by dollar strength, by weak import prices, improving supply chains. I don't expect that impulse to help the Fed quite as much. I get the idea that globally commodity prices are soft because we have a China slowdown in the picture, but we're seeing signs of gold and copper picking up, and I think that's basically a precursor to global commodity prices perhaps picking up, and that's not good news for the Fed. Cutting interest rates, the market is pricing more aggressive cuts from the Fed than, say, the ECB, Bank of Canada, or BOE at the moment. I think that's going to lead to some dollar weakness as well. So I'm not very optimistic that the disinflation in goods is going to be sustained. And I think we're going to have more volatility when it comes to domestic services prices and rent inflation. So too much uncertainty, in my view, is priced in with regards to bringing inflation down to 2%.
We've got to leave it there. We appreciate your insight going into the Federal Reserve decision tomorrow. Blarina Urici of T. Rowe Price on the latest. Let's set the stage for you. So we had retail sales out a moment ago, basically in line on a control group, a slight beat on a headline number. Little bit better than expected. What does it mean for the bond market? It means this: yields up 4 basis points on a 2-year. So yields have been declining for 3 consecutive sessions going into this Fed meeting, and we're giving some back. as the meeting begins in Washington?
On the margins, maybe giving up the hopes of some sort of massive 3 consecutive 50 basis point rate cuts. This isn't massive moves compared to what we've seen recently. Nonetheless, it just shows that to any degree that this would have been settled, it was not. To any degree that this could give people more conviction to pile into this trade, it did not. And for anybody who feels like this is a clearer picture, it is not, and that is sort of where we are right now.
Equity futures still positive, though, up by 0.4% going into this opening bout. Let's continue the conversation. Joining us now is Ashok Bhatia of Neuberger Berman. Ashok, I want your thoughts on the data, and then we'll shift towards what it means for the Federal Reserve tomorrow. Take it away, please.
No, I think on the data, it's just another data point that kind of indicates the U.S. economy is slowing, the labor market's slowing, inflation's on track to be in sort of the low 2s by next year. And we're sort of moving towards the softer side of a soft landing. And I think that's another data point that's consistent with that. For the Fed tomorrow, it's a close call. We kind of lean towards that it will be a 50 basis point cut. And, the rationale for that is there was a movement, or at least some members that wanted to go 25 in July. The inflation data has been a little bit better since then. Labor market, as you've all talked about, some of the internals there suggest a little bit more weakening. And then there's no meeting until post the election. So it's a close call. But I think, the main thing for the bond market is whether it's 25 or 50, the bond market, the policy rate's 5 3/8. And the bond market is priced for the Fed to take it all the way down to 280 now over the coming year and a half or so. There's a ton priced into the bond market, and it's going to be hard, we think, for the Fed to deliver all of that based on what we know now. And that's kind of a recipe for a little bit of a backup in yields from here.
Yeah, that raises the obvious question. When you start to work through that, and I'm looking at the same thing, you're basically saying 280, which is where the long dot was in the June projections. If we're priced for that, and that's the destination, and the journey's faster, the cuts are going to be deeper, how much value is left in this bond market rally? You're saying we're vulnerable to a backup in yields. Is that the longer end of the curve, and what kind of numbers are you thinking about?
We think you could see maybe, the bond market after the big rally that we've seen, we think it's very unlikely we're going back to some of the yields we've seen over the last 12 to 18 months. What it means is maybe the 10-year could get back up to around 4%. The bond market is going to be more stable because the easing cycle is going to begin. The Fed is going to get back to neutral. So it's more of a potential backup of that 30 to 40 basis points in yield rather than something that's a lot more draconian. And, as you were mentioning, whether they go 50, 25, it really matters for the 2-year maturity point. For a lot of the other maturity points, it's really about where does this thing end? And it's an easing cycle that probably will end somewhere around, 3%. And, that's pretty consistent with, I think, what the Fed's thinking and what the data's suggesting.
To that point, the long end, though, is influenced by what short-term policy does now in terms of what that path looks like. 2 guests this hour, 1 guest last hour, saying nobody's talking about inflation. We're trying to talk about it. People seem to have dismissed it. I'm just wondering, from your vantage point, if the Fed cuts by 50 basis points, we'll be talking a whole lot more about inflation and potentially the ramifications for the long end.
Well, 2 quick thoughts on that. I think for the Fed's big message that's likely coming is, they're going to try to get the market to get off this 50-25 focus and more focus. We're going to get back to neutral. That's probably around, maybe 3.5, something like that, 3 to 3.5. It's going to be a message of getting to neutral, but we're not thinking that we need to get easy policy. And that will be a bit of a, I think a message the Fed will be pushing more. But on the inflation front, the bigger issue we think that's coming is fiscal policy. And I think you were speaking about this in the last half hour, which is, the Trump tax cuts are set to expire. If nothing happens, those expire at the end of next year. The long end, has been worked up about, fiscal spending, but there's a pretty decent chance the next 12 months we're talking about the degree of fiscal retrenchment. And that's, we think, going to be a bigger issue for the bond market and a lot of valuations than inflation, which is pretty clearly in our minds on a trajectory back to the low 2s by mid to end of next year.
Ishak, if you're saying financial retrenchment, are you saying buy the long end aggressively because we're going back to some sort of, some kind of more repressionary or restraining kind of backdrop with the fiscal, which has not been seen for years and years?
Would not go that far, but would just say that some of the pricing that we've seen earlier this year around term premium and fear of fiscal deficits and fiscal spending continuing at sort of at a pace that we've been on, that's likely to change. And so more of a message that the long end will find more stability than not.
It's such a cheat code for this show that you can come on and say you were talking about fiscal policy in the last 30 minutes or so. Don't even have to watch the show to know that you were probably talking about fiscal policy in the last 30 minutes.
He was watching.
Well, I wanted to talk about Shogun. That's what I wanted to talk about.
Okay. That's such a sore topic.
I hope you finished watching season 1 because, as you know, Ashok, Bramo totally ruined that. I wanted to bring up credit just briefly. I just want to bring up credit briefly and do something sensible. At the start of August, I remember you saying, after the shakeout that we'd seen in financial markets, particularly in credit as well, that you were looking at increasing credit exposure. I assume you did that. We've had a round trip since early August. Where are you now on that front?
We did, and I would generally describe us as a platform as we've taken off 3/4 or so of what we added into that backup. It was a pretty, in the grand scheme of things, a pretty small backup. And, high yield spreads are back towards the low 300s. Main message on credit is, credit is likely to stay pretty range bound, and volatility about the economy is going to be more in interest rates in the Fed than credit. If we do see a backup of credit again, I think, we'd likely be adding, but here, it's kind of back to a little bit more neutral.
Got it. All bases covered today. Appreciate it. Thank you, sir. Ashok Bhatia there of Neuberger Berman on the latest in this credit market and fixed income more broadly. Equity futures on the S&P just about positive by 0.3%. Let's give an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Recapping that print, U.S. retail sales unexpectedly rose in August, pointing to healthy consumer demand. Sales rose 0.1% month over month. Economists were expecting a drop of 0.2%. Excluding autos and gasoline stations, sales advanced for a 4th straight month. Meanwhile, a new Morning Consult poll shows Kamala Harris with a 6-point lead over Donald Trump. Among likely voters, Harris leads Trump 51% to 45%, a record in Morning Consult tracking. The survey reflects daily data collected from September 13th to the 15th after the candidates' debate a week ago. And Elon Musk's super PAC is set to spend more than $2 million to fund Republican congressional races in battleground districts across the country. The latest federal filing is the first major push from the Tesla founder to influence elections outside the U.S. presidential race. The group named America PAC is supporting candidates in the New York Westchester suburbs and 3 incumbents in California. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the rest of the week. The calendar, the trading diary, just around the corner.
There are many global investors that aren't interested in China.
So we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
These are the scores. Stock still positive by 0.4%. Bond yield still very close to the lows of the year so far, pushing higher by just a single basis point, 363.25. No big disappointments in retail sales at 8:30 Eastern Time. As we count you down to the opening bell, about 40 minutes away, this is a trading diary of the calendar for the next few days. The Fed's 2-day meeting kicks off later this morning, ahead of tomorrow's decision, followed by a Chairman Powell news conference. We'll get some forecasts in the mix as well. On Thursday, another round of jobless claims, and then we'll talk about other central banks. The Bank of England on Thursday and the BOJ on Friday. For some final thoughts, Mike McKee is back with us down in Washington, D.C. Mike McKee, put it all together. We've got all the data now. What's this discussion going to look like later on today? What's it going to sound like tomorrow afternoon?
Well, it's going to be a very interesting discussion, and I think going into it that Jay Powell had maybe an inkling that some members of the committee were with him on the idea of a 50 basis point cut, but there's certainly not been any data over the past few days that would push for one way or another. So he's going to have to talk people into it if that's what he wants. And can he do that? That's an interesting question. We haven't seen much movement in Fed funds futures or overnight index swaps since the retail sales numbers come out. Basically, the markets have decided we're going to sit here with a good odds on 50 basis points, but still pricing in the likelihood of 25, I think.
Mike, your guess. Are we going to get dissent?
That's a really interesting question. We were talking about it here with the ECO team in Washington. There is a theory that if you got a dissent, if they went 25 and you had a dissent, somebody wanting 50, at least one person, then you'd sort of have a hawkish 25, and that would reassure the markets that the Fed is staying on top of the idea that the economy could be weakening more. So it might be a communications benefit. If they went 50 and got a dissent, it would suggest that maybe the inflationistas were worried about that. And so there could be some communications aspects to this, to a dissent that we haven't seen in a long time. But it's been almost 3 years since anybody dissented, and none of the governors have dissented since 2005. So it doesn't look like that's a likely prospect.
Almost 20 years. I find that stat absolutely bonkers. Michael, thank you, sir. Michael McKee, looking forward to the coverage from Mike McKee tomorrow afternoon to break down this Fed decision. It is all to play for as this two-day meeting kicks off.
Can you imagine if an alien came down and heard our conversation about what the balance of risks is? I mean, basically, people parsing hairs to try to get an advantage at a time of deep uncertainty in the economy and Fed policy.
I think they'd be confused by what interest rates were and what they're used for.
They might be confused about the things.
Why are they doing that? Why are they doing that? What are they talking about? Yeah, I think they'd be confused about pretty much everything. Anyway, coming up, we don't have a higher being, but we do have Julian Emanuel of Evercore, Torsten Slock of Apollo, Alicia Levine of BMY, and Earl Davis of BMO. Your Fed decision coming up tomorrow.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
All right, futures indicate we're going to get close to another record high on stocks this morning. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are off today. Bloomberg Open Interest starts right now.
Coming up, retail sales unexpectedly rose in August, providing one of the final slices of data before the Fed decides on rates tomorrow. And exactly what the Fed will do remains front and center of market minds. We'll discuss with Morgan Stanley's Brian Weinstein, JP Morgan's Gabriela Santos, Evercore ISI's Ed Hyman, and Julia Coronado of Macro Policy Perspectives. And on the corporate front, Microsoft launches a $60 billion buyback as Intel scores a major deal with Amazon. Let's take a look at where the markets are trading right now. In terms of the futures, we continue to see gains here. S&P futures up about 25 points. We were at 56.33 yesterday, and the record high for a closing high is 56.67, so as near as damn it to it. NASDAQ futures up about 0.7%. You do see the 10-year yield right now rising just about 1 basis point. In terms of the stocks to watch, Danny Berger is going to take you through some of the big corporate moves. Danny?
Got to kick it off with Intel, up nearly 4% this morning, landing a big customer. That is Amazon's AWS, but it's also postponing its planned factory in Germany. Microsoft, that is up 1.6%, a $60 billion share buyback, one of the biggest in history, a continuation of what they had before, and they're going to rise their dividend by 10%, rounding things out with Hewlett-Packard, up 3.8%. This is some sell-side activity. Bank of America upgrading it to buy from neutral, citing the Juniper deal and cost cuts. Matt.
All right, we have breaking news from the Justice Department. The DOJ is ramping up scrutiny of banks that collectively lost billions of dollars in the collapse of Bill Wang's investment firm. Prosecutors are reviving an antitrust probe into whether banks colluded in discussing how to unwind their Archegos bets. We'll have much more on this story later in this hour, although I think it's fair to say that those banks that tried the hardest to avoid losses lost the most money. So it seems like they've already had quite a bit of punishment there. In terms of retail sales, we had this sort of final slice of data coming out before the Fed decision tomorrow, and we had an advance in retail sales. So U.S. retailers posting a surprise gain in August. Let's break it down with Michael McKee, Bloomberg's chief international economics and policy correspondent. He joins us from Washington. Mike, what do we see?
Well, we're not seeing anything that's going to convince one side or the other in the 25-50 debate, but it does suggest that the U.S. economy is certainly hanging in there and doesn't seem to have a lot of problems. There are some issues under the hood, however. You take a look at overall retail sales, and they were up 0.1%. The forecast was for them to drop. And the control group, 0.3 after 0.4 last month, so still a very strong retail sales component there. And you can see on the top line there that that's GDP now from the Atlanta Fed, 2.5%. Some people think that's going to go up to 3% after today's numbers, so not an issue with the overall economy. But there are some things, as I said, under the hood that are a little concerning, and one is that the composition of sales is a little worse this time. We have seen some areas that people thought would be strong be a little bit weaker, including food stores and grocery stores, department stores and clothing stores, which during this month usually do well. I want to show you this chart here and just take a look at two colors, the forest green that you can see on top of these and the deep blue. Those are internet sales in the forest green and auto sales in the deep blue, and you can see they have really pushed around retail sales. This is the ECAN chart on our Bloomberg, and you should get one if you don't have it already. But it shows those have been the issues that have really moved markets around, or moved retail sales around over the last year. What does this all mean? How you started asking me? Doesn't seem to be much to markets, because when you look at what the markets are pricing in at this point, there's been very little change in overnight index swaps or in the Fed funds futures market. This is swaps. And as you can see, since retail sales came out, there's not much of a change. People still think that there's a chance of 50 and there's a chance of 25.
All right, Mike, thanks very much. Michael McKee there in Washington walking us through retail sales with the ECAN function on your Bloomberg terminal. We are joined now by Morgan Stanley Investment Management Head of Global Markets, Brian Weinstein. Brian, you're best known for your work in fixed income. So you really, I think, have a unique perspective among people who watch sort of cross-asset management. The bond market expects a 50 basis point rate cut. Do you as well?
You know, I've been in the 25 camp all year. Even when we were pricing in 7, pricing in 0, they're going to go 50. I mean, I think the theme was right. They should have gone in July. Right? The best news is the debate will be over really shortly, because it doesn't really matter. But I think when you look at the Fed, the path from July to now, we didn't get a lot of data that's clear, right? Jobs were weaker, inflation mixed, but obviously trending towards 2. Retail sales better, bond market doesn't care. The Fed has an opening. Well, listen, we know 2 things. 5.5% is not neutral. The second thing, let's not forget, 5.5% was not nearly as restrictive as we thought. The economy is not cratering. So the Fed needs to go from 5.5 to neutral. We don't know where that is. Start with 50, get the ball rolling. Could it be a hawkish 50? Is that possible? Could they pull that off? Give the message that we're not starting a huge easing cycle here, but let's get towards neutral, and let's do it now because we want a soft landing. Those are really hard to find.
Could a hawkish 25 do something about, I know we're literally splitting hairs, but you know, this scenario where they go 25 and they do dots, they do a summary of economic projections that suggests that bigger cuts are to come.
Well, yes, your second point is perfect, right? The Fed needs to give us something to look at. They said, look at the data, and the data says do 25, or by the way, maybe don't, right? But don't do 50. So the data thing wasn't really right. So what is their forecast? Where are we going? And where do they think neutral is? Listen, the bond market says it's 2.8. I think that's way too low. If 5.5% didn't kill the economy, what if it's 4? Right? I mean, if you had told me 3 years ago we'd be at 5.5 now, and we'd stayed there for a year, we all would have laughed. It was impossible. So we don't know where they're going. They need to give us more. I think the important thing here is they don't fall behind the curve. Again, soft landings are hard to find. We know there are parts of the economy that are struggling, right? Inside the consumer sector, you can see it on the ECAN, right? If you look at where the strength is in retail sales. So ease and give us some guidance. But so far, I think what they've done is let the market dictate where they're going and leave us confused. The equity market seems to see it. The equity market says we're going to be okay. Usually as a bond guy, I think the bond market's right. I think the bond market's pricing in way too high of a chance of recession. I think the stock market has it correct.
Does that hurt to say?
It does, a little bit. It's hard for me. But the stock market was right on 10-year notes at 1%. Right? They said, no way. There's more growth. There's more inflation. Stock market was right. So it's been on a roll.
Well, wait, just to be clear, something that's like cutting 200 basis points in the span of a year, for you, is that just normalization, or does it indicate something worse?
I think it's unlikely that that's the path. I think that's the market's probability-weighted outcome of where we end up. I think the Fed is saying with 50, and I hope they say this, more now in the hopes that we don't have to do a lot. I could see them doing 125 before January. And can we speak about rate hikes next year? Right? And not today. But if it's a soft landing, and if inflation does bottom, and if we do help out that other piece of the economy, get through the election, get some spending from the government, could the economy continue to be okay? Well, then we'd have a totally different story. I think the market's priced wrong for 200 in a year, but we could get 200 by March if needed.
I'm just so confused about why we need these rate cuts, and I'll ask you, and I'll ask Gabriella, and I'll ask Ed, and I'll ask Julia, right? Because what's growth right now, like 2.5%, 3%, you know, and earnings were fantastic. Stocks, you know, risk assets are at all-time highs. And I can only imagine the outcome of a 50 basis point cut to be higher prices for housing, right? And affordability is one of the biggest problems this nation faces. So I feel like they can only exacerbate those issues that are driving, the electorate crazy.
Yeah, I have a lot of sympathy for that view. I think from a market standpoint, just from it's not really theoretical, from a functional standpoint, if 5.5 is restrictive, and I think we'd all agree, to some degree it is, and inflation has gone
Where do you see that? Where do you see the restrictive
listen, I think you see it at mortgage rates at 8% were pretty difficult for people to deal with. Now at 6 and change, we don't see a ton more activity, so to your point, maybe that's not the problem. Affordability could be, but you see it certainly in weaker consumers. You see it in subprime auto, right? You definitely see it. It's not affecting the economy writ large, but if you had 9% inflation for the a year ago, and you've gotten government subsidy, and those subsidies are running out, I think people are feeling the pinch. So I agree with you. My message would be we're doing this 50 because we're calibrating. That would be my word. We're calibrating. It's not a big easing cycle. The economy doesn't need it. It's a bit more of a textbook response of getting real rates to a normal level. Look at financial conditions indices. I can't think of a cycle in my career where the Fed was easing with financial conditions this easy. So the risk to me that the market is missing, it's not in break-evens, it's really not in the yield curve, and it's not in fixed income, which is why I think it's incorrect. There's no inflation risk, there's no risk to fiscal, there's a yield curve that's way too flat for this part of the cycle, and if neutral's 3.5, the 10-year note should be 5, not 3.6.
All right, Brian, you're going to stick with us. We're going to talk more with Brian Weinstein, Morgan Stanley. Quick check on what's going on in terms of futures. And as we've been pointing out, the retail surprise didn't really move the market much. You still have futures up on the S&P 500 about 0.5% right now. NASDAQ 100 futures up higher, 0.75%. And the 10-year yield actually not moving at all. Right now stuck at 362. And I believe it's that way if you look really across the U.S. curve. Coming up, Trump hopes to regain momentum after the gunman incident at Mar-a-Lago with 48 days until the election. We'll talk politics next. This is Bloomberg.
Names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Let's get now to high interest. Look at what's making headlines around the world. The U.S. Justice Department is ramping up scrutiny of banks that collectively lost billions of dollars in the collapse of Bill Wang's investment firm Archegos. It was only months ago that Wang was convicted for deceiving those firms. Now prosecutors are examining how those firms, Wang's lenders, unwound more than $150 billion in bets placed by his family office. This, according to people familiar with the matter. UniCredit is set to ask the ECB for regulatory permission to build as big as a 30% stake in Commerzbank. That, according to a person familiar with that matter. CEO of UniCredit, Andrea Orchel, is still in pursuit of a potential takeover of the bank in Europe, is longing for its first big cross-border takeover. And talks between the PGA Tour and the Saudi-backed Live Golf Tournament have dragged on for over a year since their shock deal, their announcement of a merger, thanks to one little detail: player pay. John Rahm's reported $300 million Live contract struck late last year is a particular sticking point. Some PGA players want Rahm and others to hand back money that they've made from Live, but that's terribly unlikely to happen.
Matt, would you give your money back if
Absolutely not.
Yeah, I was going to say mine would be gone. There'd be no more money to speak of. It'd be in some houses and something. Anywhere elsewhere, Matt, let's move on to D.C. Donald Trump is pinning the second assassination attempt on him on Kamala Harris and Joe Biden's rhetoric this election season. It's an effort to sway momentum in his direction after weeks of majority attention on the Democratic changes to the ticket. Let's bring in Bloomberg's Michael Shepard in Washington. Mike, I mean, is it going to be successful this time? This is a similar tack they took on the first attempt on the former president's life. Is it going to make a difference this time?
Well, it's a great question, Danny, because we're entering now the home stretch of the campaign. We have 7 weeks roughly to go, and early voting is beginning in some states very soon. So there's no time to dawdle or to waste opportunities. So Donald Trump is looking to make the most of this now. He is attempting to pin some responsibility on Kamala Harris and President Joe Biden for inciting somehow the two men, the gunman in Pennsylvania from July and the man who was apprehended on Sunday, for somehow being responsible for those the actions of those two people. But he offered no evidence, and the FBI, even as it's been investigated, has seen no connection whatsoever between the rhetoric from the vice president and the president in terms of stoking what has happened. So it's unclear whether that will hold with voters as a whole. It does play well with Trump's base, though.
Are you concerned, Mike, about the Fed taking some flack for the cut tomorrow? I mean, especially if it's 50 basis points, do you expect the Trump camp to then come out and say, you know, it's unfair that the Fed is just doing it to boost the Harris economy, the Biden-Harris economy?
Well, for months, Republicans have been seeding the ground for exactly that scenario and saying that look for what they would call a politically motivated rate cut right before the election to somehow help juice the economy and make those numbers look better for the Democratic candidate heading into November 5th. Now, we also know, though, from political research and from years of studying elections that voters' impressions of the economy really take hold more in August than September, so that by the time anyone might feel the actual effects of a rate cut, except for maybe an immediate trading on the exchanges on Wall Street, people have made up their minds about how they feel about the economy and what it feels like at home. So it may not have that kind of effect, even though Republicans may be suggesting there could be a political motivation here.
Michael, appreciate it. Bloomberg's Michael Shepard there. Just want to bring us quickly some breaking news, more eco data. Tier 2 data, call it what you want. U.S. August industrial production data higher than expected. It rises 0.8% month over month. 0.2 was the expectation. That accompanies retail sales data that was also stronger than expected. Not too much of a change in the bond market. Front-end yields up some 3.5%. Okay, we're still here with Morgan Stanley investment head of global markets, Brian Weinstein. Brian, I want to ask about what Matt was kind of alluding to, this idea of a cut being political. You have Elizabeth Warren and company writing a letter to the Fed, and we can talk about the fact that maybe she does this quite frequently before Fed meetings, but saying that they shouldn't go 20, not 50, but 75. Does it represent something dangerous of trying to influence the Fed, or just noise?
I think it's noise, right? I think it's fine. I mean, the senators have the right to write letters to the Fed, and they're public, and we can read them, and the Fed can react or not. But in this case, I think
presidents can do it.
Presidents can do it. Yes, and that's more problematic, maybe. Maybe they shouldn't. But listen, I think if the Fed were not priced to do anything, it would look very political. But 75 seems a lot. But it's in the right theme, and it's going to happen-ish, and it's a little bit of noise, I think, around what the political situation is very noisy, I think, for Wall Street. I think what's interesting is, I think what the market's saying is we're looking through it. Don't give us a blue wave or a red wave. Please let it be a little chaotic, right? Let there be an offset, a balance, whichever way it goes. And if you can give me that, we can actually figure out we're not going to get outlandish policy on either side, and the markets will be okay. It'll be interesting if that changes, but for now, I think it's noise.
I got to get your take on equity markets now that you're running global markets. What do you think about this stock market? Others? Are we off to the races now that, central banks around the world are in cutting cycles?
I'm surprised we're back at the highs. I thought we'd be range-bound a bit more. But again, if the market is looking through to elections and then our Santa Claus rally, which always comes, I don't think we're going to melt up. I think we've done that. But a break to the upside here, especially if yields stay this low, leaves us with not too many alternatives. Yeah, I could see us continuing to grind and really frustrating people. It's interesting that leadership keeps changing. I think if the Fed is easing and we get some more stimulus from China, which has been a big drag, and Japan decides to slow down a bit because it's gotten a little noisy, and they like, I think, a bit of inflation. I do think you could see some strength back in commodities and energy, which has gotten hit, which has weighed on the indices and kept some of the bigger ones down. But yeah, I like the U.S. market. Again, we've seen some strength out of Europe despite their lagging economically, and the ECB on a bit of an easing cycle. I don't expect that to change just yet. But if we can get the dollar to be really fundamentally weak, we might be able to see some leadership move overseas at some point. It might be a next year story.
I'm worried you're already talking about the Santa Claus rally
in
September.
I know, it's
comes
coming.
Earlier every year.
Comes.
You talk about the change in leadership. Utilities have been on this amazing tear, on track for their best year since 2014. The Bank of America Global Survey just came out saying that investors are most overweighted since 2008. What is this thing? Is it safety? Is it AI? Is it everything to everybody, and it's only up from here?
I think it's a weird combination of safety and yield, right? So listen, a lot of people missed their chance at a 5% 10-year note, and so we get some income. It's, if I'm wrong, it's cyclical, it's defensive, and I'll get some safety. I am surprised that we had the rally. They stabilized, tried to come down, and then found new highs, despite the fact that then big tech comes back and leads again, and utilities don't go down. I think it's a commentary on yields, and again, not to bring up an old, Tina, but I'm not loving fixed income here and wanting income. I think people are reaching. It can't go on forever, but certainly it was out of vogue for so long. It's had a heck of a comeback.
So a lot of people were worried that we were out over our skis in terms of earnings. Obviously, this quarter was great, right? But looking forward, maybe we wouldn't continue to see that kind of strength, or in 2025. What's your view on earnings?
I think with the Fed easing and again, going 50 and getting ahead of the curve again, you get a little bit of a drop in earnings because we get the lag effect. It doesn't work right away. But with conditions this easy, I think you look into end of first quarter, second quarter of next year, and you can have a big boost in earnings again. The funny thing about inflation dynamics is we went for so long where companies could not raise prices because there had been no inflation for a long time. Once you've seen 8 or 9, and it goes back to 2, I think companies have some more pricing power than they did. Again, not like they did last year into COVID with the government response. But I think the psyche of the way consumers respond to price changes is they're a bit more okay with it, which makes inflation sticky and helps earnings. And so I think as long as the Fed eases and employment stays reasonable, we can be bullish into the beginning of next year. If interest rates start to move like I think they will, that will put pressure eventually on the stock market, but obviously not today's story.
Brian, really wonderful to catch up with you today. That is Morgan Stanley Investment Management Head of Global Markets, Brian Weinstein. Okay, coming up, Instagram unveiling a sweeping overhaul today for teenage users. We're going to have the details next in your social climbers. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Time now for Social Climbers, the companies making waves this morning. First up, Starbucks. They're looking to hire a global brand czar with its new CEO, Brian Niccol, attempting to revive the coffee giant's sales. The role will oversee marketing, product, and store concepts. And related news, the company's North America CEO announced his retirement yesterday after 12 years at the company. Next up, to Boeing, they're implementing a hiring freeze and temporary furloughs for some employees. The troubled plane maker is preparing for a drawn-out and expensive strike by workers at its main hub near Seattle. Boeing also halting non-essential travel and cutting back on air shows and charitable donations. Finally, Instagram is rolling out new privacy settings for teens. The social media platform will make teen accounts private by default, limiting the use of private messages. The app will also block teens from seeing sensitive photos and videos. These restrictions will be turned on automatically for all Instagram users under the age of 18. Those restrictions for those under 16 can be relaxed if a parent gives permission.
Under 16?
And Matt, I mean,
can you be on Instagram if you're under 16?
Don't they just lie? Can't you just lie about this and say, like, I'm my own parent, I'm turning on the restrictions off? Like,
But-
how is this going to work?
I mean, would you give your kid a cell phone under that, like, access to those things? I don't think that would be allowed in my household.
I think kids should only have Motorola flip phones until like 20 anyway.
The
I think
Razor. The Razor is what you get until college.
Yeah, I had one. I blinged it out. It was pretty cool. It's pretty sweet. Had some bling on it. Anyway, you can follow all the latest buzz on TRE and Go on your terminal this morning. Matt, futures doing anything?
Yeah, let's, well, exactly what they were doing last time we looked. S&P futures up 0.4%. A little bit of a rally in the small caps. Russell 2000 up 1%. The closing bell is next. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams. That's right. And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Just moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are gaining, and we could have another record high on the S&P 500. Right now you can see S&P futures up 0.4%, adding about 23 points. NASDAQ futures up 2/3%. The Russell 2000 up about 0.9%. You hear the opening bell on the New York Stock Exchange. Oh, everyone's taking pictures. And then on the NASDAQ marketplace as well. This could be a pretty cool day, right? Because we closed out at like 56.30, a little bit more than that yesterday on the S&P 500. We only have to climb less than 40 points to make a record today, and it looks like that should be pretty easy. These are the actual cash prices. It's going to take a few seconds for things to settle in, but we're already at 56.53, and 56.67 is the record close. 56.69 is the record intraday. So we could definitely be there, especially if the market, if the equity market continues to buy the bond market's message that the Fed is going to cut 50 basis points, and that's usually what stocks like to see. Then tomorrow, of course, we're going to get buy the rumor, sell the news action. In terms of the individual stocks that are moving, we're still keeping an eye on Intel. Remember, yesterday the stock rallied because it's going to get military contracts that are going to open up $3.5 billion of government largesse. Well, it's found another customer in Amazon, apparently. They're going to make a chip together, a fabric chip, which apparently works for AI, and that's a great thing to say for investors, right? And as a result, the stock is up another 3.5%. So a gain for a stock that has been a true loser this year. Intel, like the pioneer in chip making, has fallen 60%. The stock is worth a total of less than $90 billion. So very interesting stuff there. Danny, what are you watching today?
Well, I'm watching Microsoft, and sure, Intel got a vote of confidence from AWS. Microsoft is giving itself a vote of confidence. They raised their quarterly dividend by 10%. They also announced a $60 billion share buyback. Now, that does match the size of a repurchase they had done 3 years ago, but this is still a monster buyback in the scheme of things. Those shares up nearly 2% just out of the gate on the opening bell. I'm also looking at HPE this morning, Matt. This is from some sell-side action from Bank of America. They have upgraded it from neutral to buy, up 5 1/3% for HPE. The analysts there, they're confident in their deal to buy Juniper. There had been some head scratching around how they would fund this and if it would be an issue, but Bank of America says that this is a cyclical recovery coming from them across networking, services, and storage. Matt.
Well, cross-networking services and storage.
What more do you want?
HPE, my eyes kind of glaze over. I feel like they need a rebranding because that's just not exciting. Let's discuss the Fed. That is exciting. And markets with Gabriela Santos, JP Morgan Asset Management, global market strategist. Gabriela, Danny Berger cannot stop the debate. 25 or 50. It's
much
it's
as
all
I
she
tried.
talks about.
Much as I
I'm
tried.
sure it's all everyone talks about around you. What do you think? What are they going to do?
Yeah, so I think the direction of travel, very clear. Rates are coming down as the Fed normalizes rates. But very much for tomorrow, there's so many unanswered questions around the magnitude, 25, 50, the frequency, monthly or quarterly, and the end point, right? What's the normal interest rate for the economy these days? I do think now that bond markets seem to be pricing in about a 60% probability for 50 tomorrow. Two-year yields have come down for 5 months in a row. They might be disappointed tomorrow, not because I think that they shouldn't do 50, but I don't think that they will, just given how gradual this Fed has been, just because Chair Powell tends to favor no dissents, plenty of consensus. But if we zoom further out, once we get a little bit more comfortable with these questions around magnitude, frequency, and endpoint, it's still an environment that the why rate cuts are happening are still positive for risk assets, right? They're coming because it's a normalization of rates and in conjunction with a soft landing.
A normalization of everything, really. I mean, it seems like the labor market, right? 4.2% unemployment. That's not bad. 3.4% was what was abnormal. And if you believe Bill Dudley that we're getting to this tipping point and things are going to get worse, I just don't see how, right? Mickey Bowman was talking about last year how, immigration really swelled. Can I say that as an active verb? The labor pool, right? It grew because of so many foreign-born workers. That has stopped now, that, flow of immigration, and it doesn't seem like there's any reason. Earnings were great. Why would the labor market be such a problem?
Yeah, I think very much what we've been seeing across a whole different number of job market indicators. We need to look at a whole bunch to put together a picture here. It's still very much just normalization. Normalization of the demand side in terms of the pace of hiring, and normalization in terms of the labor force participation rate. But I think for the Fed, they're still a bit uncertain about how long this immigration surge will last and this increase on the supply side. Number two, some more mechanical questions about some changes in surveys, how they're calculated, response rates. So for them, I think if they're in the business of managing risk, which they are, they're willing to be a bit more proactive to make sure that we do continue just seeing normalization and not a worse weakening in the labor market. Hence why they're being more forceful about saying the time has come for rate cuts, for a normalization of policy.
I was going to say, managing of risk sounds like a different shade than data dependence.
Yeah, they're not data driven at this point, are they?
Right,
Are
if
they
they're
still
managing
data
risk.
dependent?
Actually, are they?
I think they are looking at the data and realizing that in terms of managing risk, it has become much less about inflation, much more about the labor side, and a focus on labor market indicators from here on out. And you can actually use large language models to comb through different speeches by Fed members, the statement, and what you start to see is they're mentioning the labor market about 30% of the time, and inflation only 20%. So it's very clear. They still say the balance of risk is balanced, but I think by their speeches, they're actually saying that the balance of risk is actually on the labor market side. And that's really the justification for cutting tomorrow, for normalizing policy. I think that's how Chair Powell will phrase it at the press conference.
I mean, you see a very clear view, but it is a market that's torn. To your point, we oscillate somewhere above 50 for deciding whether this will be 20 or 25 or 50. We look at retail sales data as like the data point that matters. We're reading the tea leaves from the FT and Journal stories. Is this a problem that that's where we're at, just days away and now 1 day away from a Fed decision?
I think that is the reason why interest rate volatility has stayed still quite elevated versus pre-pandemic norms. So it's off the very highs that we touched middle of last year, but it's still quite elevated because we need more information, which I think we'll get with the release of the updated summary of economic projections, especially the dot plot, around exactly what's the pace of rate cuts here. So I do hope we have a little bit more clarity. In terms of retail sales, I don't think it changed the game really. It came pretty much in line with consensus for the control measure. It still suggests an economy that's doing quite well, just normalizing a bit the pace of growth, but no concern here in terms of the overall pace of consumption.
All right, so normalizing rates with the normalized pace of growth. What about portfolio construction? Do we normalize positioning? I mean, do we normalize balance?
Yeah, I think there are several action calls here around normalizing portfolios. For example, we've all talked a lot about how there's $6 trillion plus of money sitting in money markets and cash-like instruments. I think that's been the approach recently on the fixed income side of portfolios. So it's time to normalize your actual amount of liquidity versus your core fixed income allocation, which is really there for income, for diversification in terms of recession. And really, I think after tomorrow, when it's absolutely obvious there's reinvestment risk, we do expect to see a lot of money flowing into especially short to intermediate duration fixed income. We'd rather have moved before. You're not at the best price you could have gotten, but it's still pretty decent income there. And then in terms of normalizing on the equity side, right? Portfolios have gotten very lopsided into the US versus elsewhere, into Mag 7, mega cap tech, versus other sectors, and you finally started to see that broadening happen. Early days, we think there's a lot more to come here, so important to balance there between sectors and styles and regions.
What is the elsewhere from the US that money should flow to?
And here is where I don't think we're, I think as human beings, we tend to focus sometimes on the negative news that we hear, especially as investors from international, because they've disappointed for 10, 15 years. But there's actually been very strong performance for the last year and a half, almost 2 years here. We're very, very, very constructive on Japan, Japanese equities.
Early August was rough.
Early August was rough, but the glass half full way of looking at it is that multiples have contracted 17%, right? There's another bite of the apple. It's not really the macro, although that's getting less bad from a nominal perspective. It's all about corporate governance reforms. So much more about domestic, about the value style in Japan. We're having so many conversations with our institutional clients about it. And then it's EM, especially outside of China. Big play on AI with Taiwan doing very well, but could Korea be a more discounted option? And then we're also looking to India, very, very expensive if there are any pullbacks, any rationalization of valuations there. So there's a lot of good stuff.
Well, Gabby, let me just say, I'm so looking forward to tomorrow when the 25 versus 50 debate is put to an end, so we can actually move on to
I hope so.
Yeah, then we can focus on Japan, and I mean, we should do a show from there. We should go with Gabby to Japan.
I was going to say one exists, but we could take it out. We can commandeer it. I'm not against it.
We already have one.
Yeah, we do have a Japan show.
That's true.
We can all join the Japan show.
Exactly. Gabby, looking forward to seeing you in Japan. Gabriela Santos of JP Morgan Asset Management, thanks so much. Okay, coming up, Virgin Galactic landing a $5 price target from Morgan Stanley. We're going to have the details in your top calls next. This is Open Interest.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
there is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg Open Interest. Quick check on stocks. You can see that we're up 0.4%, 56.55. So 56.56. So just 11 points away from an all-time closing high. Time now for our top call. Some of the analyst action in focus this morning. First up is Spotify. It is higher following an upgrade to a buy at Redburn Atlantic. Analysts say that the company is a prime beneficiary of expected accelerated growth in the U.S. e-commerce. Sorry, Shopify. Did I say Spotify? Shopify, as you can see there, up 1.3%. Next up, let's get to JP Morgan says that Viasat is no longer a buy. The firm cutting its recommendation on the satellite broadband provider to neutral after United Airlines chose to partner with Elon Musk's Starlink instead to provide its in-flight Wi-Fi. Let's hope it works. And finally, Morgan Stanley slashing its price target on Virgin Galactic to just $5 from $35 previously. They maintain their sell rating because you can't really go much lower than that. Analysts say there are a few catalysts in the near term with no flights until 2026 and more technical risks ahead. Danny?
Ouch, yeah, it's not the one. They're not the ones doing spacewalks out there, are they? Okay, Matt, we had some breaking news at the top of the hour. Let's revisit it. The Justice Department is ratcheting up a criminal probe into whether banks colluded while unwinding Archegos' bets. Banks that tried hardest to pace the fire sale ended up with the biggest losses. Bloomberg's Ava Benny Morrison has been covering the Archegos blow-up and joins us now. It's weird, Ava, because these were the banks that, in the trial of Bill Hwang, were painted as victims. So why is the DOJ looking into them now?
That's exactly right. During Bill Hwang's trial earlier this year, the banks testified about how they were misled by Archegos and Bill Hwang, but now antitrust investigators are looking at some of the conversations that those banks had after Archegos collapsed. So in the days in March 2021, when the banks held a number of conversations about whether they should have a orderly liquidation plan to sort of minimize their losses. Some of the banks like Goldman Sachs and Morgan Stanley split early and unwound Archegos' positions, but others like UBS, Credit Suisse and Nomura agreed to a slower kind of liquidation. So antitrust is looking at whether that amounts to collusion or at least a conspiracy to collude to control stock prices.
And they lost the most, right? The banks involved in the alleged collusion are the ones that took the biggest hit.
That's right. Those three banks that I mentioned, UBS, Credit Suisse and Nomura, that slowly unwound their positions and had an overlapping of different block trades. They were saddled with the lion's share of the losses. Credit Suisse alone lost more than $5 billion.
First I want to say this was one of the most exciting trials that I've ever followed on the Top Live blog. Like, it was amazing the way you guys reported this out. And I just wonder, did the banks in that testimony during that trial give any information that could be used against them now in this investigation?
Not that I heard of. It was very much focused on the information that Archegos and Bill Hwang and his lieutenants provided to the banks to be able to get more money from them to further his trading. So it was very much about those conversations, what Archegos had articulated about the extent of its positions with other banks and its risk profile.
How far along is this investigation? Do we have any idea?
We know that it was first opened in 2021 after Archegos collapsed, but it sort of took a back seat to the Manhattan U.S. Attorney's Office investigation, which resulted in a criminal trial. But there has been a flurry of activity since Bill Hwang was convicted a couple of months ago.
Well, I very much look forward to your T-Live coverage on this one as well, Ava. Thanks so much for joining us. Bloomberg's Ava Benny Morrison. Coming up, Trump's banker is picking fights with pretty much everybody. Whistleblowers, Marxists, short sellers. Find out just how far he's willing to go next. This is Bloomberg.
spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Quick check on what's going on in the stock market right now. We do have gains, and we're getting back closer to all-time highs at 5650 on the S&P. The NASDAQ gaining a little more, 0.4%, and the small caps on the Russell 2000 up more than 0.75%. The market preparing itself for, I think it's fair to say, what it now believes is going to be a 50 basis point cut tomorrow by the Fed.
Yeah, it's been pricing that in, more than 50% odds that we would get that, but it's like Fed roulette, choose red or black and hope you get it right. Okay, time now for Wall Street Beat. Back when Donald Trump's empire was facing troubles and nobody else would lend to it, one man would. His name is Gregory Garabrandt, and he's the head of Axos Financial, and he's one of Wall Street's best paid CEOs. Here with more on it is Bloomberg Business Week's Max Ableson. Max, this is such a good story, full of character and color. So who is this man?
Thank you so much. Well, I just want to say that one of the good things about being a journalist, like a reporter, is that, we go through life being like, who is anybody? Other people, whether or not they're powerful, are like a total mystery to us, I think. And one thing that was really fun about writing about Gregory Garabrandt, who is the CEO of a relatively small bank called Axos, although actually I should say it has gotten much bigger over time, is that I went into it knowing very, very little about this guy. And by looking at a couple of things like lawsuits, and also by doing a lot of interviews, I ended up with what I hope is like a pretty colorful and I hope a really accurate portrait of a guy who, he is willing to do what it takes to win in his way. And that means, and I don't want to give away my fun story, but it means getting into lawsuits with, short sellers, and Axos has had a lot of short sellers, or at least a group of very intense ones, whistleblowers, his kid's school, believe it or not, his neighbor. He's a guy, he says he's not litigious, but what I would say is that there are some Wall Street types, some finance types, including Greg Garabrandt, that when they fight, they are not messing around.
Yeah, scorched earth was a term I read in the story. Also, I think he might debate whistleblower, right, as the correct term. I think it's a great story, and what I love about your stories is I always read them till the last paragraph. So, also a very fascinating man that you chose to report about. The company, to me, was, I thought, really interesting. Before he took over, it was a very small financial institution, and it was a weird name like Bank of the Internet or something.
Bank of the Internet.
Right? And now, even though they've had their issues with Hindenburg and they've had their issues in recent months with stock depreciation, it has soared over the time that he's been in charge.
Soared. I mean, let me give an argument for this guy. He took over a bank that was making, I want to say, like $3 million a year. Pennies, pennies. I think it had like $1 billion of assets, which, if the three of us worked really hard, we could start a bank with $1 billion of assets. That's very tiny. Actually, I'm not sure we could. No offense to the three of us.
Very confident that
with the two of you, I'm sure we could do it.
But let me just say that he came in with a vision, and he wanted to, when you say Bank of the Internet, or I say Bank of the Internet, it had no branches, and it used that as like a cost-effective measure to grow. But he also did something really interesting, which is that he was willing to lend to customers sometimes that other banks were not willing to get into business with. Now, he, of course, says, look, I often turn away customers that other banks would be willing to do business with. But we looked in this story at customers like Alex Jones's media company, Binance US, and then, of course, there's Donald Trump. And, while it may not literally be true that no one was willing to lend to Donald Trump, Trump's empire was under a squeeze there for a second, because Deutsche Bank, other banks he had gotten money from after the January 6th riots, they were like we're not going to do business with these people any longer. Greg Garrabrants and Axos, essentially one way of thinking about it is that they helped prop up Trump's empire at a really crucial moment. And what he would say is, look, I did it because the math worked. It's a good loan. The case against Greg Garrabrants, the case against Axos is like the metrics are too good to be true. All of that incredible rise can't be believed. And then very importantly, they are too far into commercial real estate at too scary a time. So we're going to have to see what happens. I'm honestly, after spending all this time studying the bank and reporting on the bank, I'm not even sure myself.
I mean, after all that time, because you go into this and there's some high-profile instances with him, whether banking with Trump, be it the lawsuits, be it the short sellers. Over the time you spent on this story, how did your view of him change?
You know, I have to say, it really did change. And in some ways, I think I have him to thank for that. Like, sometimes in journalism, you get in touch with someone. Let's say I'm trying to write about Matt, which I'm really glad I don't have to write about Matt.
Me too.
It'd be a great story.
That would not be good.
You know, you end up, first you start with other people. You know, I would speak with the people who work with him and know him best, and then you start to get a picture, and then you know you come to him with questions, and sometimes Matt says, "Buzz off, Max. I don't want to talk to you. I don't like your tone." And credit to Greg Garrabrants, whatever anyone might think of him or what anyone might think of bank CEOs, he was willing to take our questions really, really seriously. And what he said is, "I pray every night for the wisdom to make the right decisions." And you know, he may have politics that sound you know, intense or out of place, at least in New York City. He rallied, as I think someone mentioned, you know, against like a Marxist curriculum at his kid's school. But from where he's coming from, the perspective that I got is that like he is a guy who wants to run his bank well. He's a guy who wants to win on his terms. He's a guy who, like, I got the sense that he sort of like despises mediocrity. You know, he does not want to be mediocre. He does not want to work with mediocre people. He doesn't want a mediocre bank. And, you know, as a finance reporter, I can't say whether that's like good or bad. All I can say is like, I found that really interesting.
He's a champion of free market capitalism, which when I was a kid, that was okay in America. You know, Max, great story. Really appreciated you joining us, reading it and you joining us. Max Abelson there. Get your story on the Bloomberg with NI Big Take Go.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube. So head over to youtube.com, search Bloomberg Radio, Bloomberg Podcast, any which way we'll get you there. Coming up, we're going to check in with Simon White, Bloomberg News macro strategist. He's over in London. Give us his thoughts on what the market's discounting here ahead of the Federal Reserve tomorrow. Jill Blanchard, President of Enterprise Client Solutions at Advantage. She's going to join us to discuss those retail sales. And then, for me, the highlight of the morning, Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. She's going to be in studio. She's based in Dallas, but she'll be in a New York studio. Give us her preview of this Fed, and she is an avid Fed watcher. Folks, hang on her every word. Look at this. This check on the markets is brought to you by Interactive Brokers Portfolio Analyst. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for a Portfolio Analyst at ibkr.com/free PA with our news in New York City. Here's John Tucker with Bloomberg Business Flash.
All right, Dow at a record. S&P 500 kind of hovering just below its record close. Best performing major index that belongs to the Russell 2000 right now, small and mid caps. And in the S&P 500, best performing major indices group that belongs to consumer discretionary. The biggest drag right now coming from healthcare. S&P 500 17 points higher. That's up 0.3%. 5650 on the index. 5667. That was the record close. The Dow 45 points higher, up 0.1%. 41,667 right now. And the Nasdaq 192 points higher. That is up 0.5%. And traders slightly adding to bets this morning for a 50 basis point interest rate cut from the Fed tomorrow after that mixed retail sales report that we got earlier this morning. Laura Cooper at Nuveen says a 50 basis point cut from the Fed could actually backfire.
This is not a time for the Fed to really potentially spook markets. There's a risk that markets could extrapolate that 50 basis point move at further meetings, further loosening financial conditions when financial conditions are already quite easy.
And Amazon's AWS web service is going to be a customer for Intel's manufacturing business. As a result, Intel shares getting a pop. They're up 2% in this morning's trading. Microsoft raised its quarterly dividend 10%. Also announced a stock repurchase program worth around $60 billion. As a result of that, Microsoft shares, they are up 1.7%. Yields 2-year, that's up just about 6 basis points, 360. The 10-year, 2 basis points higher. Yeah, that is at 364. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele is off on assignment today, but not to worry because Norma Linda, who covers markets for Bloomberg News, she's sitting in for Alex. North, thanks so much for joining us.
I'm here.
Awesome. We got a big 2-hour schedule coming up, so we're going to get right to it. We're going to go right to our good friend Simon White. Simon is Bloomberg News macro strategist. He's based in our London office there. Simon, it seems like the narrative for this Federal Reserve and rate cuts has kind of shifted over the last couple of weeks from being 25 basis points is fine Anything more than that would suggest that the economy is, in trouble. Now it seems to be the consensus that 50 basis points is okay. What's changed?
Yeah, I mean, in the blackout period as well, the quote-unquote blackout period, yeah, we obviously had a couple of, leaked stories. There's clearly people on the Fed that would prefer to do a 50 to kick off. Powell probably quite prominently among them. But, there's two things here. Obviously, that's what they said they're going to do, so you don't lean against it. But it could be counterproductive. If you look at previous soft and hard landings and how much the real Fed rate falls, in soft landings, it maybe falls peak to trough, I don't know, maybe 200 basis points.
Right.
Over about 9 to 12 months. But hard landings is much, much more. It's much deeper, much steeper. So doing a 50 basis point cut to kick off kind of like feels it's more consistent with like this is a hard landing than a soft landing. So it could be counterproductive in terms of giving off the wrong impression. So that's one thing to be concerned about.
And it seems like, I guess Fed Chairman Jay Powell is going to have to defend to some degree or provide support to some degree for whatever he does decide, the Fed does decide 25 or 50 basis points. What do you think the messaging is likely to be from the Fed Chairman tomorrow?
Yeah, I mean, obviously, this is what happened in last December. They had the pivot, which kind of came at the time when there was already a lot of interest rate cuts already priced. And we had this, I think unnecessary, because as I say, the market was already deeply discounting quite a few rate cuts. And then they came in and they were quite dovish, which kind of like emphasized these rate cuts. So here, they've got to be very careful, and I'm sure maybe they won't make the same mistake twice. By doing a 50, they really have to roll back and sort of say all the usual signs of caution. Inflation is lower, it's towards target, isn't at target. We're still got some lingering concerns about X, Y, and Z. We're not overly concerned about the job market or growth. But even then, as I say, I don't know why they're actually doing this. I don't see the issue with doing a 25. I don't know what the hurry is. And especially, we're now just like hair's breadth away from the S&P making a new high. So again, you get strange kind of messaging. Financial conditions are clearly not particularly tight. And yet here we are doing a 50 basis point cut. So it doesn't strike me as necessarily being prudent and sticking to longer term goals where maybe you could be a little bit more patient.
Well, Simon, so we've got 25-50. We'll find out what happens tomorrow. But what we do know is that the Fed does not like to have dissenting votes. Are there any expectations of that happening in terms of the discussion around the size of cuts?
Yeah, I mean, as you say, look, they don't really like having any dissent. They also don't like surprising the markets, which is why I think the market was correct to largely ignore the retail sales data, which, was probably a slight beat in aggregate. The lesser watched industrial production, which I think is actually even slightly more significant, also came in on a monthly print, much, much stronger than expected. None of this stuff is really consistent with a soft landing, but a hard landing. But the Fed is, renowned these days for not wanting to surprise the market. And as you say, not wanting to have any dissenters. Whether they're able to achieve that, I don't know. I mean, I actually don't follow the sort of internal politics of the FOMC too much, more just because I think if you're kind of bombarded by, all the kind of like the ups and downs and the noise essentially, it can be distracting from what the bigger picture is. I sort of feel that if the Fed's got something to say very loudly, it will get through. And that's what happened obviously last week. We had at least two leaked articles saying that they were, edging for a 50 basis point cut, which meant you could probably ignore largely a lot of their other commentary in the days before.
Right.
So, Simon, both the Bank of England and the European Central Bank have already begun cutting rates. To what extent will they be? What are they going to be looking for tomorrow from the U.S. Fed? Are they kind of they're out ahead of the Fed in cutting rates, but how are they going to view the Fed's action tomorrow?
I mean, it gives them obviously a bit more flexibility. I mean, the irony is if you look at early August, the Japan carry trade unwind, so late July, early August, that's really when the implied odds of recession, if you look at short-term rates markets, really ramped up in the US, right? Not based on the data, the economic data, it was based on market turmoil, and it never really corrected. Whereas if you look at the implied recession odds in the UK and Europe, for instance, looking at short-term rates markets again, it only inched up a little bit. And it's kind of ironic because there's actually a higher risk of recession in the UK and Europe than there is in the US.
Right.
And yet here we are looking at the implied odds. The market is saying to you that there's a higher chance in the US. So everything just seems about face, which is why ultimately I think that, you know, there is going to be some sort of reversal here. I mean, maybe the way you look at it is through yield spreads. So you look at basically US versus European or UK yield spreads. You know, if I'm right, if that supposition is correct and the recession risk is more likely in UK and Europe, these spreads should widen. You know, when that happens and how that happens, obviously I don't know, but that's my suspicion. Just looking impassionately at the data, I think that's the direction things are going to end up going in.
All right, Simon, thank you so much for joining us. Simon White, he's a macro strategist for Bloomberg News, joining us from Bloomberg's London headquarters, Queen Victoria Street. We had some economic data, of course, today. Retail sales came in better than expected. Retail sales, the headline came in at 0.1% positive for the month of August. The expectation was negative 0.2%, so better than expected. The prior period also revised up. So that it's kind of a little bit different than what we hear from some of the retailers who kind of call out the weakness that they are seeing, particularly from the lower end of their consumers. But let's break down some of these numbers. We can do that with Jill Blanchard, President of Enterprise Client Solutions at Advantage Solutions. So, Jill, what did you make of the retail sales data we got this morning?
So, hello, and thanks for having me back. It was a surprise, right? This could be indicative of many things, but the first thing that I'll point to is earlier holiday spending. And so retailers have been pulling holidays forward with good deals, and it's kind of working. 63% of consumers said that they would buy products earlier if on sale. Holiday creep's always been a thing, but it's so exaggerated today that virtually every week of the year, there's some sort of holiday in store. We saw that this summer with Summerween, if you've heard that term before. So the back to school holiday shared shelf space with ghosts and skeletons and a lot of orange and black. TikTokers were making jack-o'-lanterns from watermelons. There were skeletons on pool floats. Starbucks brought the ever so popular pumpkin spice latte out earlier than ever before. And home improvement stores jumped on the bandwagon with halfway to Halloween in April in hopes of addressing their sluggish sales as well as trying to deplete that inventory so they have less to discount come the first day of November. So that could also be, you know, leaning in towards this increased spending.
Well, Jill, love a pumpkin spice latte. That's a good that's a good call out there. I wanted to know, so of course, when we're looking at retail sales earnings and just all the data that's coming in, it can really feel like a slew. We can't really get a read on the consumer here. Has this offered us any more clarity?
Offers more clarity. You know, probably not. Because again, consumers are really shifting the way that they spend. The predictions for this holiday season are to be softer than last year at 2% versus 3%. We do see consumers continuing to buy, but trying to buy lower cost alternatives. We saw that with back to school, where the volume was flat, but the dollars were down, indicating that they're buying, they're just finding cheaper ways to buy things. And I think we're going to see that this holiday season too, especially with things like the deep discount Chinese shopping apps, Temu, Shine, TikTok. 2/3 of consumers have shopped those apps, and that's a number that we'll likely see go up. And I bring those up as the examples to answer your question because it's blurry out there, things happening in both directions.
Jill, for this holiday season here, how promotional do you think retailers are going to have to be to drive their top line?
They're going to have to continue to be very promotional to drive their top line. Historically, pricing and promotions were used to boost year-end sales, but now they're used to boost everyday sales. And it's really driven by how consumers are spending and potentially a permanent shift in how they spend. And so we see a lot of growth from discount retailers, private brand, sales in general, and consumers are definitely leaning in towards those strategies. In some households, are doing even more things, you know, like using alternative pay plans, like a buy now, pay later, getting a second job, sharing groceries, leaning on social media. The hashtag back to school hauls was a huge help to parents during back to school season.
I mean, I think when we're looking at this, and the market has really been on edge with investors really worrying about the consumer and how it may hurt the economy and the labor market. I mean, does this really show that the consumer may be stronger than many people think?
Oh my, I'm so hesitant to lean into that. All predictions for the back half of this year, as well as the holiday season, aren't incredibly positive. Economists think that consumers will rein in their spending in the back, even though we didn't see that with the results this morning, will rein in their spending in the back half of this year due to depleted pandemic savings. Lower income households have record levels of credit card debt, uncertainty. And those low income households, by the way, are disproportionately affected with inflation. We saw that a few weeks ago when Dollar General said that the weakest 3 weeks of their quarter were the last weeks of each month, indicating that consumers are really struggling to stretch that budget. So for those reasons, I'm super hesitant to lean into overall growth in the back half of this year. We still think it's going to be depressed.
What is skimpflation?
It's a great question. I'd say that this industry is not short of creativity, right? So we all know what shrinkflation is. We talked about upflation, which is that concept of finding a new use for an existing product. Skimpflation is the concept of producing a product or a service with a lesser quality, or not quality, lesser price ingredient. So for a food product or for a piece of clothing, that could be a cheaper ingredient or material. For a service, that could be something like a hotel stay with no cleaning service.
Yeah, I've seen that more and more, but less and less now after the pandemic. Pandemic was really prevalent. Now it's less so.
Definitely. I mean, we can't really look at any one data point, but as we're looking toward the Fed tomorrow, of course, this will not necessarily play into this one, but we're looking toward the next job report. How is this just telling us about the strength of the economy more broadly?
Yeah, so there's a lot of discussion around the rate cuts and what that might ultimately do to spending. Historically, spending goes up about 0.5% in the year following a rate cut, but also goes down 2 to 4% in a recession. Where we are, soft, but not quite a recession. We could see a slight decline in 2025, but overall, it's going to take a while to revitalize the economy via the rate cuts.
Just real quick, Jill, how important is brand loyalty these days?
Oh my gosh. I can't tell you how many times I say this. The new loyalty is disloyalty.
Oh.
Which the new loyalty is disloyalty. We are training consumers to be disloyal. We are training them that there is always a deal to be had out there, whether it's at a different outlet or whether it's waiting. So loyalty's definitely declined, and retailers are trying to get that back. So for example, take retailers' loyalty programs. It's a great way for retailers to pull that consumer into their store for that trip because it's the only place to get that price. But consumers beware. It often does have consumers buying things that they didn't need or more than they need. In fact, we just did a recent survey where 80% of consumers said that they're buying more product than they need because of a good deal.
Yep.
So it's a great strategy for retailers, but consumers beware.
Entry load is what it's called. Jill Blanchard, thanks so much for joining us. Jill Blanchard, she's president of Enterprise Client Solutions. The firm name is Advantage Solutions, joining us via Zoom from California today. And, talking about the retail sales, again, kind of came in a little bit better than expected. If the Fed was maybe looking for one more smidge of a data point to say, I don't have to go 50, maybe I could go 25, maybe this data point,
this is one.
Maybe this does, we'll see how it goes. We'll have it all tomorrow, Bloomberg coverage of the Fed day. S&P 500 up 0.5%, the NASDAQ's up about 0.8%. Hey, the Russell, the small cappers are the strong performers today, up 1.1%. 30-year Treasury, let's do the 10-year Treasury, 3.64% on your 10-year Treasury. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, we are on records watch. Dow Jones Industrial Average above its record close. S&P 500 hovering right around its record close. Pricing from the CME has the odds of a 50 basis point rate cut from the FOMC 63% right now. Best performing group in the S&P 500 that belongs to consumer discretionary right now. Retail sales unexpectedly rising for the month of August. Got those figures this morning. That's supported by online purchases that pretty much mask some more mixed results at other merchants. And then shares of Intel this morning, they were up 3.5%. They've landed a new customer. Not just any customer, it's Amazon. Amazon's AWS is going to be a customer for their manufacturing business. Intel and AWS will co-invest in a fabric chip. That's a custom semiconductor for artificial intelligence computing. S&P 500 right now, 30 points higher. That is up 0.5%. 56.63 is what, 3 points away. Dow Jones Industrial Average, 192 points higher. That's up 0.5%. At 41,815. The NASDAQ 100 up 106 points. That is a rise of 0.6%. Yields also on the rise. The 2-year is up 5 basis points. That's at 360. The 10-year yield right now is 2 basis points higher. That is at 364. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Nora and Paul.
Hey, JT, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele, who was on assignment today. I am Paul Sweeney. We're live here in our Bloomberg Interactive Brokerage studio, streaming live on YouTube. That's the internet, I'm told. So head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. All right, this guest was total Alex Steele segment.
This is her jam.
It's energy. It's all that geeky gigawatt and all that kind of stuff.
She loves it.
She bails on us. So I'm going to, you and I are left to do this. Kate Richards, we love talking to Kate Richards. She's the CEO and co-CIO at Warwick Investment Group. We love talking to Kate just to get a sense of what's happening in the world of, global energy, natural gas, crude oil. Kate, thanks so much for joining us here in our studio. Let's talk about just WTI crude oil. We're at $71 a barrel here. We did fall below 70 here. Give us the state of just global crude oil. Is it a supply issue that's been pulling oil down, or is it demand, or a little bit of both?
I would say it's probably sentiment more than anything else. There's nothing that could explain a $20 to $25 barrel drop in prices for oil fundamentally. But it's very important to remember that oil is often not a fundamentally driven commodity in terms of pricing. The financial demand for oil and petroleum products is actually 30 times the size of the physical market. So if you look at all of the contracts that are trading for oil and oil products such as gasoline, jet fuel, et cetera, that market is 30 times the size of the actual physical market for oil. And so what that means is that the financial sentiment around oil can actually have an enormous impact on prices that isn't actually reflected in fundamentals. And I'll talk about fundamentals in a second. If you go back to 2015 to kind of illustrate the point that I just made, in 2015, we had a 2% oversupply, so not horribly oversupplied market, that triggered a 60% price decline. Wow. That doesn't happen in a normal market. You don't have like a 2% oversupply in multifamily and a 60% decline in rents. So that's fundamentally what we're dealing with in terms of sort of the sentiment around oil, and that kind of goes to the hedge fund point we were talking about earlier. I will say that the sentiment around oil is a little bit driven by Chinese demand. So Chinese demand numbers are not great. They actually contracted in Q2 on a year-over-year basis. However, 2023 was exceptionally strong. And China's about 17% of the market. When we look at, the idea that you could extrapolate Chinese demand to what's actually going to happen in oil prices, I would say two things. Number one, the correlation of Chinese demand to global demand, so 17 million barrels a day of demand to what happens with the other 83 million barrels a day of demand, is like 6.8%. So on an R-squared basis, that's meaningless. Okay. And if you look at Chinese demand, when you look at Chinese demand to non-OECD demand, which has been a driver of oil growth, and so that's important, it's like 0.1%. So obviously meaningless as well. So China's weighing on sentiment, but we need to think about what that actually means in terms of global demand growth. And the last thing I would say is that oil and gasoline demand were at all-time highs last year, and they are also at all-time highs this year. So really nothing to
Below
explain.
$3 a gallon coming in.
He's our
This is like-
gasoline correspondent.
This is our guy.
Because
At
he
the
drives
Wawa,
500 hours a
by the
day.
way.
Well, I mean, the Fed can thank oil prices for being able to, even entertain a cut. If you had $90 to $100 oil prices right now, it would be
What
very
is that
difficult
on an
to cut.
inflation-adjusted basis?
Good
That's
question.
deflation.
Good question. Oil is at 2004 levels.
Wow.
Which is incredible for the most probably valuable commodity in the world.
So, I mean, of course, we're sitting here in a very special week. We've got the Fed tomorrow. How does this all play into that? Expand a bit more on that.
Well, obviously, I think when you look at the impact to consumers, we also are thinking about it being an election year. And I would not say that the correlation is, it's a spurious in terms of correlation and may not be causal. But normally we have weak oil prices in an election year. That's number one. Number two, it's refinery turnaround season after peak driving season. And so you are going to have, refineries undergoing maintenance, so they will be consuming less oil. That will make demand look a little bit worse. And so we're seeing a little bit of an impact from that. But, when you look at like overall inflation levels, inflation has cooled over the past year, but we're not back to 2019 levels. We're still, if you look at the price of bread to gasoline, you're still much higher than 2019 levels. And oil just has helped a little bit because it probably really is undervalued, especially relative to the cost of supply.
Alex has been, I think, on the forefront, at least from my perspective, in reporting on this whole AI play for global energy. And it comes down to simply, you're going to build all these computer farms and things and all that kind of stuff. Somebody's got to fuel it. And the question is it coal? Is it gas? Is it oil? Is it nuclear? How do you guys think about that whole thing? Because people are trying to say there's an energy play here to AI.
Yeah, I mean, the future of AI is going to be who controls the energy infrastructure related to it, clearly. And so then the question becomes, is it natural gas? Is it nuclear? Is it renewables? Is it coal? I think that, what we see as big tech is certainly hanging hopes on the AI revolution and the growth in data centers that will be needed on a nuclear renaissance. And there's some interesting things to say with respect to that. So number one, uranium prices are down 20%. And that's partly because Kazakhstan announced that it's increasing production a bit. Secondly, the House and Senate just passed a ban on Russian imports of uranium, which is about 20% of the U.S. market. U.S. is the largest consumer of uranium in the world, and that kicks in 2028. So the U.S. consumers will be needing to look for alternative sources of supply for about 20% of their supply. And lastly, we are starting to see groups like Amazon go and buy nuclear power plants to see if they can power some of data centers with uranium-powered nuclear. Nuclear is clearly carbon neutral, and it also has the most uptime of any power producing asset in the world. It's like over 90% uptime. So uranium is very interesting, especially given the sell-off. The other question is how much of this is powered by natural gas? And that is a very interesting strategic question for the U.S. because the U.S. North America is a natural gas province, and we are the Saudi Arabia of natural gas. And we have cheap domestic sources, especially with gas at $2.40. However, gas is in pretty steep contango. So December 2024 prices are at $3 an M versus $2.40 spot prices, and next year it's at $3.80 an M. So that it shows that we're in pretty steep contango. The market's expecting future higher prices, but remember, gas is fundamentally driven by weather. And if winter doesn't show up this year, as it has not for the past 3 winters, you could see lower prices.
Although I have to admit, I just got a tweet from one of my favorite ski resorts out west. It snowed last night. It's coming, baby.
That's good news.
It's coming, baby.
It's almost time.
So nat gas. Now I just looked at my little Bloomberg chart. It's down like 30% from recent highs over the last year. So, is that a supply issue?
Yeah, you've had a fair amount of new supply come online in the U.S. because of drilled and completed wells. And you also have to remember that most oil wells in the U.S. produce natural gas as well. Like 30% of Permian production right now is natural gas, and as those wells get older, they become gassier over time. So this is one of the reasons that people have confidence in building petrochemical and LNG export facilities in the U.S. because we have such robust supply, and we're even getting it basically as a free byproduct from our oil wells.
And I know, as we were talking about earlier, hedge funds are net short oil for the first time since the data started being collected in 2011. I mean, when we think about smart money making this decision, do you think that that permeates into the rest of the market when we're looking at investors more broadly?
I think tactically, number one, it's refinery season. It's refinery maintenance season, so your bid for oil is less. That's number one. Number two, it's an election season, and usually prices go down into an election. I mean, you could say an incumbent, that's in the interest of an incumbent. Yep. And then lastly, you have a weak Chinese number, and that is going to spook the market, although we do not think weak Chinese demand can be extrapolated to global demand today. So if I were tactically positioning, I would say I would be pretty net short too. However, but I would probably close that trade out pretty quickly because we have probably the most disciplined OPEC we've ever had. And OPEC, under the current Saudi leadership, is very focused on price stability. They do not want 30. They do not want $120 oil. They really want it to stay in a tight band because they view that as best for their customers, and they've done a very good job governing the market. So, just an example of that is 2 weeks ago, OPEC came out and said we were supposed to increase production 180,000 barrels a day, and we won't. And that's how they're governing the market. So I think you can make these tactical trades, but you're probably trading in a tighter band. Now, it doesn't mean that you couldn't have a temporary real trade-off or trade-up, but I think you have a market that's being governed in bands the way that it wasn't in 2008, for example.
Is the fact that the U.S. is now a net exporter for the first time, like in ever, how does that undercut OPEC's ability to really be that driver of pricing?
OPEC has teamed up with Russia, and they are definitely the largest producer in the world. The U.S. is like 13% of supply.
That's still a lot, though, isn't it? On the margin, does that not impact it? Because if I got some knucklehead in Texas or Louisiana pumping oil because he or she can, and their cost is $40 or $50 a barrel, does that not impact the world markets?
It does. It absolutely does. The point I'm really making is that OPEC has a cartel with Russia, controls over a third of global production, and they have been committed to price stability. But yes, 95% of global production growth over the past 10 years has come from the United States.
Is that right?
The United States is really the only jurisdiction that's been able to grow.
Here's the final question. Can you answer this one? Because nobody else can. And I can't, and you can't. Why can't we pump gas in New Jersey? Do you have any idea?
It's the question of the day.
It actually,
I think there are only two states. It's New Jersey. I don't have a problem.
You mean
with it.
where they pump it for you?
New Jersey.
Yeah, right.
And
They have to pump it for you.
It was New Jersey and Oregon. I think Oregon just went to I don't know.
It's a good question.
I think it's a luxury.
Okay,
I agree. It's a luxury.
It's your homework.
Are we complaining?
It's your homework. All right, that's how we roll, Kate. See, when Alex is not here, we go off the rails, but we appreciate it. Kate, thank you so much for joining us. Some of the smartest talk that we have, discussion that we have on global energy, is thanks to Kate Richards, as CEO and co-CIO of Warwick Investment Group, joining us live here in our Bloomberg Interactive Broker Studio. And looking at the crude oil here, WTI crude oil up about 1.5% today, $71.18. And Brent crude up about 1.1%, $73.60. So we'll keep an eye on that, but certainly been off the highs. If you remember Bloomberg Intelligence commodities analyst Mike McGlone, he's been calling for lower oil for a couple of years. He was early, but he thinks it's 40 before it's 100, for example. And he's basically saying on the commodity front, long gold, short everything else. S&P 500, we're up about 0.5% here today. NASDAQ up about 0.75%. And the little stocks are working hard for you today, up 1.3%. The Russell 2000 10-year Treasury looking at 3.64%. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks advancing across the board. The S&P 500 gaining for 7th straight day, and the Dow Jones Industrial Average, that is above its record close right now. S&P 500 flirting with a record, just a few points away from that. NVIDIA, those shares, they are the most active right now. Those shares up about 0.5%. And, of course, Federal Reserve policymakers, all eyes on the Fed. They've started their two-day meeting. It started right around 10 o'clock Eastern Time. Lara Rain, chief economist at FS Investments, looking for a 25 basis point cut from the Federal Reserve.
I cannot recall a Fed meeting where things have been so up in the air, and it is a really close call. There are great reasons for them to do a larger cut. I also can't remember a Fed meeting where markets have been so split going into the decision.
And right now, pricing from the CME Group, interesting chart here, 63% odds, that's the betting at least, of a 50 basis point cut tomorrow. 37% according to the CME, going for a 25 basis point cut. I'm going to call that pretty split. Hewlett-Packard Enterprise among the stocks of the move, climbing. It was upgraded to buy from neutral at Bank of America Merrill Lynch. HPE shares right now up close to 7%. And Microsoft raising its quarterly dividend 10%, also unveiling a $60 billion stock buyback program. That's new. Microsoft shares right now, they are up 1.5%. Overall, the S&P 500, 31 points higher. That's up 0.6%. 56.64 on the index. The record close 56.67. Dow Jones Industrial Average up 165 points right now. That's up 0.4%. We're at 41,787. The Dow record close was 41,622, and right now the Nasdaq 100 is up 128 points. That's a rise of 0.7%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Nora and Paul.
Hey, JT, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele, who was on assignment today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're doing that streaming thing on YouTube as well. That's video, John. YouTube.com. You go over there and you just search Bloomberg Podcast.
I'm familiar with video.
You're familiar with it? Okay, very good. Excellent. All right, it is time to get right to it. I'm going right to our guest, Danielle DiMartino Booth, CEO and Chief Strategist, QI Research. You want to talk Fed? This is the go-to source. We're so glad to have her in our studio. She's based down in Dallas. She was a former Fed person down there in the Dallas Fed, so she knows a thing or two about this central bank here. Danielle, what do you think they should do tomorrow?
I think they should have. I mean, since we're doing shoulds, right? And by the way, I do analog, so it's my birthday today, so I'm just I'm right there with you with the analog.
Are you legal to drink now? Just barely.
Possibly.
It's also Liz Ann Saunders' birthday.
It is also Liz Ann Saunders' birthday. We always are like the first ones to wish each other happy birthday on Constitution Day. Anyways, I think that they should have, if we're doing shoulda, coulda, lowered in July. And I think that they know that. And I think that had they lowered in July, because they had a quote-unquote real conversation about it, according to Jay Powell at the podium, that they would subsequently be lowering again 25 basis points tomorrow, which is why I think 50 kind of makes sense, because the level of interest rates 50 basis points lower than what it is right now is appropriate, given Bloomberg's bankruptcies came in at 8 in the last week, and we've seen another one since then, the second highest this year. I mean, obviously the lag effect is taking effect in the credit markets. It's much more difficult to find funding if you're a bad building or a bad business. So I think, and it's harder to buy a car, and it's harder to refinance your home, and a lot of things say that the level of interest rates is too high, and I think that that's what they should be focused on, the level.
So you said that you think that they should have cut back in July. So what are your expectations for tomorrow? I mean, are you in the more ambitious camp? Are you looking for 50 basis point cut or 25?
I mean, I've been around the Fed for a very long time. And to say, and Bloomberg does a great job of tracking the volatility and the uncertainty of the wagers on whether it's going to be 25 or 50. We haven't seen uncertainty this high since 2007.
Wow.
In terms of the WIRP, WIRP go. So It's so difficult to say, and Bank of America came out and drew the lines hard this morning, and they're like, it should only be 25. And Michael Ferrelli at JP Morgan Chase is like, it absolutely should be 50. My buddy George Goncalves at MUFG, kudos to him. He's been saying 50 the whole time because he's looking at the level. So I think that they've done enough broadcasting and moved markets to a great enough extent to break the 75% rule if need be. But that's what it would come down to. It would be breaking the 75% probability rule.
So once the Fed does begin tomorrow, what's the cadence after that? Like, when would they like to be done? How does that all work?
So I think from my experience on the inside, you sort of know it's time to ease off on easing.
Yep.
When you start to see the lag effect from tightening dissipate.
Okay.
And those are things that are visible, right? Because BCY Go, you can track the level of bankruptcy, you can track the level of distress in the system. When that starts to ebb off, then obviously financing is opening up enough to provide adequate liquidity to the system, adequate liquidity to the credit markets. And so that's kind of when you know.
Yep.
And I think Jay Powell et al., I think what's unique right now is we've got a Fed that wants to stop with a 2 or 3% handle. They're like, we can put 3 percentage points of cuts out there and still not have to worry about going back to the zero bound, which they know is a failed experiment and encourages too much speculation.
And going off of that, markets are pricing north of 100 basis points of cuts through the end of this year. If that holds, does that mean that the later meetings would all be 50 basis? How would that work exactly?
Look, Jay Powell is the least political Fed chair since Paul Volcker wandered the buildings and gave the staff and seminars on why the Taylor rule was broken, just for fun, and did not care what Wall Street thought. Jay Powell is very apolitical. So if it needs to be 50, it'll be 50, because when he says I'm data dependent, he's data dependent. If we see that, there's enough gig workers out there that have been absorbed, and ergo they're finally starting to apply for unemployment, because we're seeing a massive runoff from the 1 million full-time jobs we've lost in the last 12 months into the part-time for economic reasons pool. I had an Uber driver yesterday, first drive of his Uber life.
Wow.
But you get that a lot, because people are like, okay, the state's going to get, wherever I live, state X, Y. Heck, if it's Tennessee, 12 whole weeks, that's their max for unemployment benefits. I can maybe get $295 from the state, or I can get at least $1,000, $500, $700 driving Uber, delivering DoorDash, whatever it is. But at some point, you're going to saturate that market in terms of, it's a lot quicker to get an Uber today than it was 9 months ago.
Yep. So, just real quick, what's the labor number that gets you spooked, whether it's an unemployment rate or just what's the labor number that gets you spooked? And maybe you might already be there. I don't know.
Well, I'm kind of already spooked. I really am. To see the rise in part-time employment, to see the economic to population ratio already dive down into recessionary territory that's on par with that of the 2007-2009 Great Recession, to see in University of Michigan bad news heard on unemployment go spiking, to see people's expectations for their income go down for 6 months in a row. That's a data series that goes back to 1980. We've never seen 6 months in a row of people saying my income is going to decline in the coming 12 months. Why is that? Because they're going from full-time to part-time. They know that we had 379,000 55-year-old plus rejoin the workforce in August. Hey, I'm going to go back to work to help my kid who doesn't have a full-time job anymore. We've got to put food on the table for the grandkids.
And I just saw that Sam's Club, they're raising the base rate, starting wages in the U.S. from $15 to $16. And I keep an eye on that, because my last job will be as a greeter at Walmart. I know that. Danielle DiMartino Booth, CEO, Chief Strategist, QI Research, joining us live here in our Bloomberg Interactive Broker Studio, which is an absolutely perfect guest to have the day before the Fed, because she and her data, more importantly, are really tied into kind of what's happening out there. S&P 500 up about 0.6%. The NASDAQ up a solid 1%. I'm going to call out the VIX for Tom Keene. It is now below 17, 16.72 on your VIX 10-year Treasury yield. 3.63%, actually a little bit of a premium to the 2-year, 3.59%. How about that? That's a steepening yield curve, is what Felicia Bromwitz tells me. Well, more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Norma Linda sitting in for Alex Steele. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Nora, are you a TikToker?
I am. I'm excited for this segment.
All right, well, good. I mean, I'm not even going to ask John Tucker if he's a TikToker. I know where that's going to go.
Sorry.
Do you know what that is, John?
What's that?
There you go. All right. Apparently, yesterday, the hearing went poorly for TikTok in its legal fight against a U.S. law forcing servers and app stores to stop hosting the video sharing app in January. That's not bueno for them. Matt Cheltenham, he follows all of this stuff, media, litigation. He's down in Washington, D.C. for Bloomberg Intelligence. Matt, can you summarize what the case was before the court and what their ruling was? Are we going to be able to still have TikTok come January?
Well, I think if TikTok wasn't concerned about a potential ban before yesterday's hearing, it should be concerned after that hearing yesterday. It did not go well for the company. What's at issue here is in April, Congress passed a law that said unless TikTok is divested to a company that doesn't have its parent in China, that companies in the U.S. can no longer carry the app in app stores. Companies can no longer host it in a way that the app can be distributed, updated, or maintained in the United States, as of January 19th. And TikTok has said, look, we can't do a divestiture. It's certainly not on that timeline. And so TikTok's only chance to survive in the United States after January 19th is to win this legal case. And yesterday's hearing was the big hearing on the case. And the three judges on the case, in my view, were not very sympathetic to the company's First Amendment case.
And so is this isolated to the United States? Are there any other, countries that are also trying to crack down on TikTok and its influence?
I think different countries are taking different approaches. The EU has taken a harder approach to tech regulation generally, and likely would apply that to TikTok without a specific ban in the same way, according to our analyst Tamlin Basin there. So this law is U.S. specific. It was passed by Congress specifically to target the company. And so it's a different remedy here in the U.S. But there's a tendency, I think, to think, nothing's going to happen in Congress. Nothing ever gets done there, just a lot of talk. Well, here, Congress did it. It's done. It's law. And TikTok's only chance to overcome it is to win this legal case.
So the parent company for TikTok is ByteDance, a Chinese-controlled company. If I misstated that, let me know. What has ByteDance said about their options, what they plan to do, scenarios?
Yeah, so that's right. That ByteDance is the parent company of TikTok. Now, TikTok is a U.S. subsidiary. It's a U.S. company. TikTok is a privately owned company, but it happens to have its headquarters in China, and that's the concern. And TikTok and ByteDance in this legal case have basically said, look, a divestiture is just not technically or legally feasible. And so there's really no indication that they're pursuing a divestiture at this point. And at least that's their indication to the court. In fact, the law allows a 90-day extension if the president sees they're making progress on a sale. But the companies, they've made no indication they're pursuing that route. They say this is a blatant violation of the Constitution, and so they think they can win in court. But I'm not so sure after yesterday's hearing.
I mean, so what do analysts think are would be the broader readout for the corporate side of things? I mean, of course, we know so many companies actually promote their products and their companies on TikTok. I mean, when I'm scrolling through, I'm always seeing a new pitch. So what does that look like in terms of advertisement and the ripple effects there?
Yeah, that's right. And part of the litigation yesterday was brought by users of TikTok that say, look, there isn't a good substitute. Yeah, there are other social media companies, but we've built our businesses here. We are expressing ourselves as a First Amendment matter on TikTok, and the government can't take that away. And there's also a big business impact in terms of TikTok's competitors. TikTok is one of the leading social media apps in the country. So if it goes away, it's a great opportunity for the competitors, for Google, for Meta. And so there are serious business implications by forcing a divestiture that isn't going to happen and effectively forcing a ban.
Is this something that could get to the Supreme Court?
Yes. So if TikTok loses in the D.C. Circuit, I expect we'll see a decision by early December from the D.C. Circuit. As I said, the key deadline is January 19th here, so there's not a lot of time. If we see a decision in December from the D.C. Circuit, TikTok's realistic only chance at that point is going to be a last-ditch plea to the Supreme Court to hit pause on this, to say, look, nothing should move this fast when you have such a major restriction under the First Amendment. The Supreme Court should issue a stay and take up this case. That's going to be TikTok's last chance to dodge a ban by January 19th if this ruling goes against it. And I'm not sure the Supreme Court will necessarily take it. Yes, it's a major question that they might be interested in. But if TikTok gets a major loss at the D.C. Circuit, the Supreme Court could say, look, you know, they got it right. We don't need to step in here. So it's not even a sure thing that the Supreme Court will take it. We'll have to watch that after the D.C. Circuit rules.
All right, Matt, thanks so much for joining us. Expert analysis there. I tell you, folks, it's hard to find that kind of analysis anywhere else but Bloomberg Intelligence. Matt Schettenhelm, a media litigation analyst from Bloomberg Intelligence down in Washington, D.C. A huge case. I mean, you think about not just all the people that are on TikTok, but all the businesses that have built upon
and
TikTok.
what happens to the dances? Are we not going to dance anymore?
Exactly.
So you get like 15-second videos of some guy chopping wood or
Where's the fun?
somebody dancing?
I don't know. So, but
And we're afraid that we're going to lose that?
It's going to be big. We'll stay on top of it. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Ira Jersey. He's Bloomberg Intelligence chief U.S. interest rate strategist. Get his thoughts. What are the markets telling him about this Federal Reserve? Then Mandeep Singh, Bloomberg Intelligence senior tech analyst, talked the latest about Intel. They're coming out with a custom chip, I think, for Amazon. That could be pretty interesting. So we'll get that. Microsoft buying back more stock, raising the dividend. We'll talk all stuff, big take. And then I think one of the highlights of the day, Max Abelson, Bloomberg finance reporter, joins us to discuss his big take story that was out late last night entitled Trump's Banker Brawls with Whistleblowers, Marxists, and Shorts. I have no idea what that's about, but it is a great story. So anyway, Max is always entertaining, so we'll get that to finish out the hour. Right now, let's go to Charlie Pellet, or are we going to John Tucker? Where would you like to go?
Well, since I'm sitting here right next to you.
We'll go to you. John Tucker with David.
We're often mistaken on TikTok. TikTok, what do we call it? Retail sales data released ahead of the Fed decision showing consumer kind of holding up, unexpectedly rising in August, supported by online purchases. And, of course, the two-day Fed meeting, that started just about an hour ago, a hike about carved in stone at this point. More traders are betting on a cut of 50 basis points. Dow Jones Industrial Average right now, that is trading above its record close, and the S&P 500 kind of knocking on the door. So what's an investor to do? Matt Mishkin at John Hancock Investment Management sees stocks getting some stiff competition from bonds moving forward.
At the end of the day, what we're seeing is the bond market still might have about an 8% total return over the next 12 months. We think that's going to be really competitive on a risk-adjusted basis.
Right now, the S&P 500, 26 points higher. That's 0.5% higher, 56.60, 7 points away from a record. Dow Jones Industrial Average up 145 points. That's a rise of 0.4%, 41,768. The NASDAQ 100 up 108 points, and that is a rise of 0.6%. And as we look at the Russell 2000, that is up 1.5% in today's trading. Microsoft climbing on a $60 billion stock buyback, Also, the dividend boost, and you mentioned Intel, Paul, planning to make a custom artificial intelligence chip for an important customer, Amazon.com, Amazon Web Services. Intel shares right now, they are up 6.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Nora, Paul.
All right, John Tucker, thank you so much. We appreciate that. Nora Melinda sitting in for Alex Steele, who's on assignment today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio and streaming video live on YouTube. So just head over to youtube.com, search Bloomberg Live Radio, search Bloomberg Podcast. You'll find us there. Good stuff. And we appreciate our friends at YouTube. As John was just reporting, I got some green on the screen here, a little bit of anticipation of tomorrow's Fed meeting. Let's see where the action is under the hood. We'll check in with Abigail Doolittle. She's a markets reporter for Bloomberg News, joining us live here in our New York studio. Abigail, what are you looking at?
Well, we do have some green on the screen, as you're just talking about, and John Tucker. In terms of the leaders today, it's interesting. There's a fair amount of tech there, but it's not the tech that we typically are thinking about. We have Intel up 6.4%. Not only did they receive the ability to build $3 to $3.5 billion worth of chips for the military, they also won Amazon's AWS as a customer. They're going to be building that custom chip. Hewlett-Packard up by nearly 6%, an upgrade over at B of A, basically seeing smooth wins ahead. We have Moderna from last week's slide recovering a little bit. That clearly is not tech, but it kind of catches my eye after I think it was down like 25-30% last week. And those are the percentage gainers. Beneath the surface from a point gain, though, here are the rest of the tech names: Microsoft, Amazon, NVIDIA, Tesla. We have Berkshire in there, but then we go to Intel, and then there's
some of those like magnificent seven names are kind of leading the way.
Having a little bit, yeah. So we've been in this time period of a rotation away a little bit, but today there's a bit of a rebound, which that is catching my eye. Apple, on the other hand, though, is still down, slightly, but down.
Right. Okay. All right. So I mean, what are you seeing anything here in terms of trading activity prior to tomorrow? Like, do options go crazy on these days?
Well, you know what's surprising to me, actually, is the fact that the gains are as big as they are. I often feel like into these Fed meetings, we're really treading water. So on the Tuesday before, and there was, some volatility yesterday too. So we have, traders pretty active ahead of that meeting. And it's interesting, this debate between 25 basis points or 50 basis points. I think that given the fact that you have the 2-year yield down about 1.5% since its most recent high into this meeting, I think this meeting matters less. I think what matters more is what the Fed is going to say about the future. Are they really going into a cutting cycle? And what I would be curious to hear, frankly, is how do they justify that? Because in the everyday world, inflation is still high. That acts as a tax on the everyday person. In addition, if rates go super low again, one area that I'm familiar with real estate-wise, despite the fact that housing prices from the last, 5 to 7 years have essentially tripled, and I would say that salaries in that area, this is an area of upstate New York, have not tripled. Rates go lower, the entire housing frenzy is going to be reignited. Now, on the one hand, that could be good because it will get some people out of their homes where they have the low rates. On the other hand, prices might continue to go higher. Housing affordability is, so I myself would be curious to hear about that trajectory. Or is it going to be a sell the news event? I mean, that's a distinct possibility only because most of the major equity indexes and lots of individual stocks such as Apple and Microsoft, they are caught in what appear to be consolidation topping patterns, which are bearish.
All right, Abigail. Thank you so much. We appreciate it. Abigail Doolittle, markets reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Want to get a sense of kind of what the Treasury market's telling folks about what we're going to hear from the Fed tomorrow. And for that, we turn to Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, I mean, this feels like, again, I'm not one of those Fed watchers, you know me, but tomorrow feels kind of important here because the Fed could go either way, 25 or 50 basis points. And I think half the market would be okay with either one. I don't know. What's the Treasury market telling you?
Yeah, so the rates market is right there too, Paul. So we're priced 50-50 right now for either a 25 basis point or a 50 basis point rate cut. I think that what's going to be important for the Fed tomorrow is how it communicates its future plans, regardless of if it goes 25 or 50. Right? They don't want to be beholden to any one path. But I think it's going to be very important, particularly if they do the 50 basis point cut. Is what is the circumstances of that cut? Is this just saying, if Jay Powell comes out and says, we're doing this 50 basis points right now, don't expect the rate cuts the rest of the year to be as large as this. This is kind of a catch-up because we probably should have cut in July. If he says that, then I suspect that you might actually see two-year yields a little bit higher tomorrow because we are priced for, like I said, a 50-50, 25 or 50. So if they and the market is priced for more than 100 basis points of rate cuts this year. So if that gets priced out, that means you're going to see slightly higher yields, even though they cut 50 basis points.
And so what do we expect to be the broader market readout, especially as we think about the Treasury market, if the Fed does not meet that more ambitious 50 basis point cut?
Yeah, if they go 25, I think that the market is going to be then much more focused on the dots, and in particular, not this year's dot. They're going to look at the 2025 dot and where the Fed sees themselves cutting to. So what's that terminal floor? So do they think that they're going to cut to 3.5%, 3%, 2.5%? Where are they going to go to? And that will affect the long end of the yield curve a bit more. And typically, if you actually go back and look at where 5-year yields tend to move versus the year forward Fed dot, they actually track reasonably closely. Not every day, but broadly speaking, they tend to move together. And that makes some sense because that part of the curve, what we call the belly of the curve, so 3-year, 5-year, 7-year, that tends to be very affected by ultimately where Fed policy is 2, 3, 4 years from now. So that's why, I think that the market will focus much more on the dots, particularly in that 25 basis point cut scenario.
Hey, Ira, Lisa Bromwitz pinged me and says, hey, the yield curve is not inverted anymore. I really don't care. Should I care?
No, I mean, this is very typical activity, actually. So someone was joking around with me, and I hope they were joking anyway, because when the curve first disinverted, when 2s10s got to be like 1 basis point instead of -1 basis point, people said, oh, there's not going to be a recession now. But typically, the yield curve does steepen going into recessions and going into Fed easing cycles. So this is very normal activity. I think the question is, how long will this trend continue? So you look at other parts of the yield curve, and I've been, I'm doing a technical analysis note right now, and I'm looking at all the yield curves and where they might go to, what are the next important technical points. And when you look at almost all of them, they're all going to be on steepening trends. And so the curve will be steeper. Different curves will wind up steepening at different paces, and the 2s10s curve in particular could end up steepening pretty dramatically from here. And we target somewhere around 75 basis points at the end of the easing cycle for that curve. So you could have a lot more to go in 2s10s for sure.
Are there any specific economic data points that you think the market could be underappreciating, especially if we're thinking from the more bullish camp that's expecting a 50 basis point cut tomorrow?
Well, I think that's one of the big questions is why go 50 right now? When you look at the preponderance of the more recent data, yes, it's been easing, but it's not falling off a cliff. And, so there's a lot of people who are in the 25 basis point camp who are saying, well, shouldn't they go slowly? Because the issue with going 50 is kind of that's a big number and a big jump. And we've seen modest easing in the employment situation, but you see the retail sales numbers, they're not horrendous. You see the inflation numbers weren't continuing to trend meaningfully lower. So I don't think there's any one number that we're underappreciating, if that's what you mean. But the market is going to take each of these data points, I think, in turn. And there are a lot of people questioning whether or not the Fed should be easing at all, much less easing quickly. And I think that's fair, given that the Fed is trying to get ahead of their forecasts here. And I think that's the reason they're going to be cutting, because they do expect the economy to slow much more significantly than it has. So they want to make sure that they're not behind the curve again like they were in their hiking cycle back in 2021.
So, Ira, once they begin cutting tomorrow, whether it's 25 or 50 basis points, then what? How does the Fed typically do it? Every meeting, every other meeting? Do they front load? How do they do that?
So it's very unusual for them to skip meetings. I think that the Fed would like to go and continue this some policy momentum and cut every single meeting, which is a reason why, quite frankly, like if they started cut 25, I don't think the long end of the market would move, because even if they cut 25, that doesn't mean they're going to stop cutting early, right? It just means that they're going to cut more slowly maybe than some market participants have been thinking and were pricing. So I suspect that they'll go 25 basis points, probably maybe for 6 meetings or 5 meetings if they go 50 tomorrow, and down to at least 150 basis points of total cuts before they reevaluate and say, okay, did we do enough? Is the economy actually slowing down more? Is it stabilizing a little bit? Do we need to cut more? So I think that even though they're going to say that they're going to reevaluate and every meeting is live and all that kind of stuff, I think at the end of the day, in the back of their minds, they'll be thinking about, okay, look, we're going to cut some reasonably substantial amount, then really reevaluate and determine whether we go more. I suspect that the economy is going to be weakening much faster in 2025 than it has so far, and because of that, I think that they're going to keep on cutting all the way down toward below 3% ultimately on the Fed funds rate. But that could be seen, right? That's my forecast, and of course, all forecasts are dangerous in that they're you have to revise them based on incoming information. So I think that that's where the Fed is, right? Look, cut 150 basis points, see what the incoming information looks like, then determine whether or not we have to cut more.
And I mean, we do know that Powell and this Fed do not really enjoy dissenting votes. What do you think would be the market reaction if we were to see, maybe through the Fed meeting minutes or anything of the sort, that there was any sort of dissenting opinion on the size, the magnitude of these rate cuts?
I actually suspect that there will be at least one dissent either way, because I think you do have a bifurcated Fed at this point. If you go back before we got those articles from the FT and the Wall Street Journal late last week, all of the Fed speakers had been suggesting something like going cautiously or modestly cutting interest rates. Chris Waller, one of the Fed governors, hinted at that as well. So I think that there is a camp, and probably 2 camps, one that thinks that they should go 50, another that can go 25. And it might be difficult for whoever is in that 50 basis point camp, if they become the majority, to convince everyone to vote that same way. It's possible, don't get me wrong, but I would not be surprised if there was one dissent, regardless of what they do, which just says, like, hey, this wasn't a close call, right? Or this was a close call, as opposed to, hey, we were definitely going 50 basis points. And I think that's important too, because that's information that suggests that, hey, the Fed knows they need to ease, the pace of which is less certain than maybe the Fed would like it to be. But that's good, and it also shows that there really is debate around the table. Jay Powell has said at a lot of the press conferences, there is active debate, and we do discuss these things. Well, it'd be nice to know, like every once in a while, someone can say, no, I disagree with this call. I think maybe we should have gone 25 instead of 50. I think that would actually be healthy for our understanding of what the actual discussions around the Fed are.
Hey, Ira, assuming they start cutting tomorrow, does the discussion about what the Fed is doing with its balance sheet, does that become less relevant?
I don't think it's necessarily less relevant. In fact, that's something I'd like to know, is how far they intend to take down the balance sheet. But we're still in a situation where there's plenty of liquidity in the market on most days, but not every day, which is kind of interesting. You look at today, and SOFR actually went up 5 basis points today because we had or yesterday, I should say, because we had settlements of Treasury securities. So I would be surprised if he wasn't asked about the balance sheet, and I do think that is something that the Fed is going to have to contend with in the next 6 to 9 months. Is where do they stop the balance sheet runoff, and then eventually they're probably going to start increasing the balance sheet. Some people are going to say that that's quantitative easing, but they're wrong about that. The Fed always increases its balance sheet as long as the economy is growing. You go back to 1973 to present, and that's always been the case. So I do think that that's important. I think they have to figure out how are their actions and how are the new facilities going to play within the financial sector. And I think that that's something that we're still learning about, they're still learning about, and something that they're going to have to be asked about more frequently as the easing cycle continues.
All right, Ira, thanks so much. once again, everything I know about the interest rate market, I learned from Ira Jersey and his research.
Who, by the way, invented WIRP, the work function.
Whoa.
Who?
Kudos to Ira.
Oh, nice. He's to blame. Okay. Very good. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. Again, really one of the smarter voices out there on rates. Everybody on the street knows Ira, knows his research, and pays close attention. So again, tomorrow, we'll see kind of what this Federal Reserve does and what kind of messaging they put around it. And Michael McKee, Bloomberg Economics, Bloomberg News, covering all things economics, he'll be down at D.C. for the press conference. Bloomberg Surveillance will have a show focusing on this Fed decision starting at 1:30 Wall Street time. That'll be simulcast on Bloomberg Radio and Television. Tom Keene, John Farrow, and Lisa Abramowitz will bring that reporting to you. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Some calling it another Goldilocks scenario. Retail sales report that we got this morning showing a resilient U.S. consumer. When you strip out autos and gasoline stations, sales advancing for a fourth month Right now, stocks higher across the board. The Dow Jones Industrial Average, that is passing through its record close. The S&P 500 hovering around its record. Market expectations shifting toward a 50 basis point cut from the FOMC. They started their two-day meeting, 10 o'clock Wall Street time. Decision is out tomorrow afternoon. Of course, we will carry that live for you right here on Bloomberg Radio and Bloomberg Television. S&P 500, 27 points higher. That's up 0.5%. 5660 on the index. The Dow Jones Industrial Average is up 172 points. That's a rise of 0.4%. The NASDAQ 100, 114 points higher. That is up 0.6%. As far as yields, the more policy reactive 2-year, that is up 6 basis points. That's at 361. The 10-year, 2 basis points higher, and that is at 364. Some good news for you, Paul. Your retirement.
Yep.
Sam's Club is hiking its pay. Owned by Walmart, store employees' starting wages in the U.S. going to increase to $16 from $15.
Solid.
Yeah.
And benefits.
Imagine what you could do with that. We check the markets for you. You what?
I've been a helpful greeter.
Oh, I don't know. Do they have greeters at Sam's Clubs?
I don't know. I'll check it out.
Maybe you can make that change.
Okay.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Nora and Paul.
All right, John Tucker, thank you so much. We appreciate it. Nora Melinda sitting in for Alex Steele, who was on assignment today. She'll be back tomorrow, assuming JetBlue gets its act together. And we're going to do some more of this stuff here. We got the Fed Day tomorrow, and it's not just us here at Bloomberg that are fixating on what the Fed's going to do tomorrow. Real people, smart people in Cleveland, Ohio, they also are going to focus on that. Anna Rothman joins us here. She's a Chief Investment Officer, lyrical soprano, lyrical soprano, CBiz Investment Advisory Services. They're based in Cleveland, but she joins us here in our Bloomberg Interactive Brokers studio. So, Anna, when you take a look at your portfolio, kind of the advice you're giving your clients, what have you been telling them about the Fed and what the Fed's doing and why it matters, or does it matter? Those types of discussions.
Oh, it matters.
Okay.
It has plateaued for over a year now, and they're tomorrow, 25 or 50. In some ways, it doesn't matter because it's just the first step that they're taking in what we believe is a cycle of cuts. It's still going to be restrictive after 25 basis points or 50. We do think that there are other considerations they need to think about, which is if you go back to the March projections and then look at the June projections, there was a huge revision, right? They got more hawkish. Now it looks like the March revisions, maybe it would have been better if they had stayed put. So if we look at that, we have 3 cuts coming up, 25 basis points each. September, tomorrow, 25 basis points, that's what we're expecting. And then maybe November and another one in December. So that's what we've been sort of relaying to our clients and certainly preparing our portfolios.
And this has definitely been such an interesting cycle, unprecedented. But I mean, when you're looking at those projections for cuts throughout the end of the year, is that based on historical patterns, or are you all, what's the thought process behind that moving forward?
I don't think history helps us here.
Right, not at all.
Yeah, no, it's, this was a pandemic-driven inflation, and the Fed had to do something pretty dramatic. Coming down, I mean, it was sort of obviously had to raise rates, right? Maybe it wasn't at the time, but in hindsight it was. Going down, I don't think is going to be as easy. And the data dependency, I think, comes from the fact that we can't rely on history, but at the same time, data dependency is making things very volatile, especially on market expectations. So we're literally we're taking it 3 cuts in 2024, but also 1 meeting at a time.
How about if you have put cash to work here? I don't know. It's kind of tough one. I think John Tucker was going to put some cash to work in some money market at 6% or something?
Well, no, the Goldman Sachs
Marcus.
But it's just like, my question is, are stocks going to see competition from the higher or from bonds at some point, fixed income?
Well, cash has been near 5, and there was no competition, right? So I'm not sure if bonds are going to be necessarily any different. Now the price it's been favorable for bonds, right? But that also means the income's going down. So lock them in.
We've heard of some people maybe repositioning the portfolio, maybe take some of the gains from the stocks that have really run, whether it's the big tech and putting. Is that something you guys do too in repositioning your portfolio? How often do you do that?
Yeah, so we have institutional portfolios, so it's pretty much fully invested, and there's an IPS that we have to stick to. So what we do is oftentimes, and we have seen this in the last, not just 2 years, but going back to pre-pandemic, a huge discrepancy between growth stocks and value stocks. So we do separate them, and when growth stocks run as they have, we take the gains and reinvest it into the cheaper stocks. So that's kind of how we deal with some of the irrationalities of the market.
So I'm always looking at interest rate sensitive sectors, as I'm sure everyone is. I look at real estate stocks, I cover them. Are there any sectors in particular that you're really eyeing as we head through this, rate cut cycle? Are there any sectors that you think could really outperform from this?
So small caps, certainly, and we have seen that actually starting in July. Also starting in July, what you saw were some REITs, public REITs that were recovering. Just to give a sense, I think office REITs, since the end of 2021, when Fed really started to raise rates, it was down like 40% or so. But you really saw that recover since July. So a lot of the interest rate sensitive areas, not every area was, Mag 7 definitely wasn't. I think those areas are poised to outperform.
And again, they're outperforming today. The S&P 500 is up 0.4%, but the Russell 2000 is up 1.7%.
There you go.
So we're starting to see that already. Anna, thank you so much for joining us. Anna Rathbun, Chief Investment Officer, lyrical soprano. I am Googling for some of her performances as we speak. That's what I was doing earlier.
Oh, no.
So I'll be checking it out on the commute home here. CBiz Investment Advisory Services, that's the day job, but a lyrical soprano.
I want to learn to hit those notes.
Oh, please. My sister's a great singer, so she's the only one that got talent.
I think I'm like an alto too. Whatever's probably maybe right before tenor.
Okay.
We can do a duet.
I can't get up there.
Do it. Thank you so much, Anna. All right, let's switch gears here. Talk a little technology here. Mandeep Singh joins us here. He is our technology analyst. Couple things I want to go to, Mandeep. Intel, finally, a piece of good news, I think. Going to be designing a chip, making a chip for a little company out there in Seattle, Amazon. Tell us about what's going on there at Intel.
I mean, everyone knows their foundry business is burning a lot of cash. It lost $7 billion last year, and there's no signs of the business turning around anytime soon. So what they've done is created an independent subsidiary for that business. Obviously, they need more funding to upgrade the fabs to make sure it can compete with TSMC. But at least there's more transparency around how much money they're losing in that foundry business, what sort of gross margin profile it has. And it just, as an investor, it gives me more comfort to see, okay, how is the core PC business doing versus what is it that the foundry is losing? And if they have to raise capital, then they can do that. So more to do with transparency. I don't think execution changes in a quarter. Yep. So it's a long story, but at least they're doubling down in the US here. So they're stopping their investments outside of US. And what it suggests is with the geopolitical tensions that there are, a lot of these hyperscalers will pivot to using Intel as a foundry, at least here in the US.
And, really what's the thought behind the play for investors that are investing in Intel? I mean, when you look at its competitors, we've got NVIDIA, I'm looking year to date, up 136%. We've got Intel down about 56%. So what is the play? What type of investor is still investing in Intel at this point?
I mean, the consensus is overly negative on Intel. Any hint of positive news is good for the stock. And look, they have to give incremental proof points as we go along. So this is by no means a turnaround in the making. No, you have to look at the incremental data points. Everyone thought hyperscalers are the ones who are spending over $100 billion in CapEx, who are raising their CapEx. Why is Intel not exposed to that? So now they have given a hint that maybe Amazon will give a small order. I don't think they are making all their chips with Intel anytime soon. And they're still going to TSMC for all the leading node manufacturing. But the fact that Intel could get a few orders from Amazon, it's a positive.
Is there a technical reason that Intel just doesn't have it to compete? Or
absolutely. I mean, it goes
they just
down
don't
to
have the they just don't have the products that customers want?
It's about the process node technology. So when TSMC says they have a 3 nanometer at scale, where they're making chips for Apple, NVIDIA, they're still trying to perfect that. They've lost a lot of engineering talent. Plus, their cost of manufacturing is 70% higher than TSMC's. So it makes it very hard to justify why would any company give an order to Intel for a leading node when the costs are higher and they're not even at parity. The only reason I can think of is the geopolitical tensions. What if something happens to Taiwan? That's where an Apple or an NVIDIA or an Amazon would want to diversify their exposure.
I mean, and Intel really used to be a powerhouse. So, I mean, what would they need to do to really see some sort of comeback? Do they need to be a bit more innovative and start looking for something that's a bit more competitive? Or does it seem like it's pretty much a universal lost cause? Is that how Wall Street is viewing it?
I mean, look, the government is completely behind Intel. So there are very few sectors where the government really supports you in such a big way. Intel definitely has that tailwind in terms of government support, $8.5 billion in CHIPS Act funding, another $3 billion announcement coming out yesterday. So they have all the support from the government. It's about making sure that translates into good yields, making sure their chips are equivalent to the likes of TSMC, and that's where the execution comes in. Do they have the engineering talent to turn around their fab manufacturing and, you know, their chips being competitive to TSMC?
Does Taiwan Semiconductor manufacture all their chips in Taiwan?
Yes.
That's a problem, dude. I mean, a Chinese and a Taiwanese boat bump into each other in the night. It could be all over.
Yeah, I mean, they have plans to expand in the U.S., in Arizona.
If I'm Tim Cook, I'm saying, here, Intel, here's the chip, just manufacture it. I mean, it's in my best interest, if I'm Apple, if I'm all these chip, to have Intel doing great, right?
Yeah, but then Intel also is a design vendor as well. So Intel makes a chip that's competitive to NVIDIA. So why would an NVIDIA have Intel manufacture their chip when Intel could also compete with it? And that's a problem that Intel has had in separating those businesses, because Intel is also a competitor to all these fabless companies, AMD, you know, NVIDIA, and that's a challenge.
But again, if I'm a buyer, I want as many chip suppliers as possible, particularly ones that are like in Kentucky or Nebraska.
Maybe they need to divest. That's a solution.
Is that
diversification? That's where it's clear that the foundry business is run completely separately.
All right, I'll make some phone calls, see if I can get that going.
See what you can do.
Mandeep Singh, thank you so much for joining us. As always, sometimes I come out more confused than when I come in. But I think I understand. I think I understand what's going on here in the
He
chip
does a good
business.
job breaking it down.
Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio. A little bit of green on the screen here, getting ready for tomorrow's Fed decision. They're meeting today. They'll have their meeting at 2 p.m. Wall Street time tomorrow. Press conference at 2:30. We will have full coverage of that tomorrow. S&P 500 up about 0.4%. The NASDAQ up 0.6. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 advancing for a 7th day. This is heading for its longest winning streak in about a month. One of the catalysts for all this is the latest data. Retail sales unexpectedly rising for the month of August, supported by online purchases. Remember, the consumer, that is the heartbeat of the U.S. economy. S&P 500 hovering around a record. You have 8 of the 11 major industry groups in the S&P 500. They are higher right now. Consumer discretionary, that is in the lead. The individual performers, Moderna, best performing stock in the S&P 500, and that is followed by Intel. Dow Jones Industrial Average, that has surpassed its record close. And, of course, everybody's on Fed watch. The FOMC meeting that started at 10 o'clock Wall Street time this morning wraps up tomorrow. Jeffrey Yu at Bank of New York Mellon says anything other than a 25 basis point cut from the Fed will lead to some unintended consequences.
There's a concern that if it's 50, sure, financial conditions will loosen, but would that smack a panic as well? We've had that panic episode in August, and amazingly, the whole curve shifted globally, not just in the US, because where the US leads, the rest of the world will follow.
With the S&P 500 21 points higher, that's up 0.4%, 56.54 on the index. Dow Jones Industrial Average up 144 points, and that is a rise of 0.4%. We're at 41,768. The Nasdaq 100 right now 81 points higher, up 0.4%. The Russell 2000 of small and mid caps, that is up 1.8%. 2-year yield 6 basis points higher, that's at 361. The 10-year 2 basis points higher. That is at 364. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Nora and Paul.
Hi, JT. Thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're broadcasting live from the Bloomberg Interactive Brokers studio in New York City. We're streaming live on YouTube as well. Axos Financial. I have to admit, I didn't know too much about them before reading today's big take story. AX is the ticker symbol. Company's got about a market cap of about $3.8 billion. Stock's up 24% year to date, up about 60% on the trailing 12 months. But they've got some issues there, and it's a subject of our big take story out there. Max Abelson joins us here. He's a financial reporter for Bloomberg News. He's in our Bloomberg Interactive Broker studio. What made you take a look at Axos Financial?
Well, can I just say that it feels good as a finance reporter to write a big take about something that you, Paul, don't know about. I mean, you know a lot about finance. And I think that,
I learned a lot.
Any of us can write about, I've written about Goldman a lot and JP Morgan a lot and Citi a lot. And I have to say, it was fun to write about a bank that, relative to them, Axos is tiny. But I have to say, I found it so interesting. Sort of anywhere I looked inside of Axos Financial, especially at the top, a CEO named Greg Garrabrants, I found myself just kind of really, really gripped by them, really, really interested in them. And I can name very briefly a couple of reasons why. One of them is Donald Trump, because when the Trump organization was having a really hard time, it had loans coming due, some of them personally guaranteed by Donald Trump. A lot of banks in the wake of the January 6th riot said, we are not going to work with this guy. And that was when Axos stepped in. So that's one reason why. A second connected reason is that they have a lot of commercial real estate exposure at exactly this dicey, fascinating time. And then I just want to say a third reason is that Greg Garrabrants is willing to get into these very interesting fights with whistleblowers, with short sellers, with his kids' school. And, I as a reporter who wants to use interviews but also documents, it was just fun to get in there and get my hands dirty and like read through a lot of legal filings. Some people might find that boring, but it was fun for me, and I hope the fun comes through in the story.
I mean, had you been thinking about this for quite a while and wanting to jump in and work on this, or was there something that really sparked and piqued your interest?
All right. Well, first of all, I wish I had the kind of career where I was smart enough to just come up with my own stories like time and again. But I have to give a shout out to the guy who sits to my right, Mike Moore, who's technically I'm kissing up here because Mike is definitely my boss. boss. But this was Mike's idea. He was like, what's up with Axos? Like, let's just look at them. Now, there are a couple of reasons why he might have said that. One of them is that Axos over the years has earned the skepticism of prominent short sellers. Obviously, our listeners know those are investors who profit when stocks go down rather than when stocks go up. And in early June, I want to see June 4th, there was a short seller, Hindenburg Research is the name, and the fellow, Nate, is the head of it. You know, they came out with a really big report that got a lot of attention. And then credit to Axos, they came out just really quickly. I mean, if it wasn't a few minutes afterwards, it was a few hours afterwards. And it just laid out, Nathan Anderson is the name of the head of Hindenburg. And basically what Axos said is that Anderson and Hindenburg were wrong, and they laid out why. And it was a hint, I think, of what I was going to find once I started digging in, which is that anytime Axos faces pressure, many of the times, Greg Garabrandt is there to fight and to win on his terms and to win his way. And that kind of character is just interesting for me as a journalist.
So the stock is up 23% year to date. So it sounds like the market's not that concerned about maybe their potential real estate exposure. What's the market think about that? What are the analysts saying?
Listen, it's not just this year. Axos stock, I don't think I've ever seen a stock chart like Axos' stock chart. If any listeners are sitting in front of a Bloomberg terminal right now, you know, look at the max time frame. If you go back to when Garabrandt took over in 2007, I mean, that chart goes up and up and up. Actually, you know what? We're such nice people here at Bloomberg News that we put that chart in our story. So all you have to do is read the story. But over that time, and this goes back to when Axos was known as Bank of the Internet, short sellers have been skeptical. The numbers are too good to be true, they say. Their exposure is too dicey, they say. And guess what's happened? As you point that out, the stock market shrugs that off. Investors have been willing to follow along this bank as it grows and grows and grows, and as it shatters its profit records time and again. Listen, I spoke with an analyst who gives the stock a neutral rating, so as close as I could get to a neutral arbiter. And this is David Chiaverini from Wedbush. He said, look, I mean, I think there are going to be losses once the environment gets bad, but you know, not huge losses. He told me he doesn't see anything worrisome. Obviously, short sellers and critics of the bank would say otherwise.
And I know that stock chart is actually up on YouTube right now, but I wanted to ask, of course, as we're heading into this election, talk to us a little bit more about the Trump tie here.
Yeah. So, you know, the way that I think about my career here at Bloomberg News is my beat is money and power. And so, of course, I tend to focus on the big banks, Wall Street. You and I have spoken, Paul, over the years about lots of fun banks. But because Donald Trump has a lot of money and power, I've been drawn to him. I tend to stay out of politics, you know, qua politics, but I'm really interested in Trump's empire. And I wrote with Sophie Alexander a really big snapshot of that empire a few years back. Things were not looking good. It was an empire in trouble because he had a lot of loans coming due, and a lot of banks were just simply not willing to work with the Trump organization in the wake of the riot. One thing that I found interesting about this guy is that he said to us, it tears at the